What's up? What's up? What's up? Good morning. Yo. Good morning. What's up? All right. Nice chill day today. Hopefully today doesn't turn out to be a terrible trading day. Looks good so far. All right. What do my meetings look like today? No, taking like a full. I have like a full schedule like every day. It's crazy. It's good crazy, but. Bum, bum, bum. Let's have a look. Oh, perfect. Good, we can film. We're gonna film new videos for like DD bands and other things. So, refilming that boot camp, you guys. Extended trial, keep going, $35 a month for 3 months. But however, for the first month, spectacular, $19.99 for 1 month. Check out all of our tools, indicators, platform, data feeds for $20 and learn everything it is that we do here. Boom. Exciting. Link below. Yesterday was pretty good. Great video yesterday. VIX is running the show now. We did have VIX expiration yesterday too. Yesterday morning. It's VIX expiration, the third Wednesday of the month. And that was a big, yesterday was a big volatility driven day, driving day. Volatility drove the boat. And we had a really awesome lesson on that. I promise I'll post that after the stream. I'll get that up there on Vimeo for you guys to watch. But yesterday was great. I took an initial long, literally closed, literally at the top, literally there, and just let the rest of the day sell. I got lucky on that one. The market's doing a couple of weird things. Like we had hedge pressure immediately was trying to break while resilience is positive. So, the idea was we were going to go to fill the gap. We went to the half gap to fill the gap. And when we got there, VIX hits a pivot. So I know that in like weird choppy markets, I'm already kind of iffy. Once I get that VIX pivot signal, it's that same scariness. Oh, there it is right here. Yep. Boy, we gotta figure out what's going on with Edge. Sorry, I've just since like when the last couple of Microsoft updates, a little unstable here on Edge. Here. So like right when VIX, like this is just an untradeable zone for VIX. You kind of need VIX to be in like a bull zone or bear zone and just decaying. Oh, I need to actually publish that. You guys are right. I have it here somewhere. Let me see if yeah, that's what I'll put in the Discord. I thought no, I didn't. You're right. I didn't take a picture and post it. What? Hey, what's up, John, dude? Been a while. It's good to see you, brother. Dude, it's so evolved now. You see the platform and how everything's going now. It's clean, right? The presentation of all of our rules now, man, we're getting it easier and easier. We're almost to the point that the next couple releases gonna be drawing arrows on a chart when we come out with new features. Right now we're building out framework instead of features. So in about less than a month, you guys, Rocket Scooter is opening up a massive trading marketplace. Massive. We already have so many of your favorites already ready to go. Put their indicators on our platform, put their discords on our marketplace, things like that. So we're about to become a next evolution of the business. So it would more like you would buy the platform and then add liquidity map to it, as opposed to buy a Pro or Pro Plus here. It'll be seamless for you guys. Y'all won't notice a difference. You'll wake up one morning and nothing will be changed. You'll have more options to buy stuff as the months and years go by. At that marketplace is out, we're going to work on a couple other things, features, automations, rule assist mode, and some other things. So we're excited about that. All right, so yesterday we had Tesla earnings, Netflix earnings, I think. Was that all yesterday, right? Let's see what we got today. So today, these are all before, so all the semis are looking good. So most of the good stuff was before market today. Axo Nobel is a catalyst company, Germany. I don't know what Disco Corp is. CSX, Intuitive Surgical. And so not really much else going on today. Netflix on a 16% price change. Dang, that's big. What about Friday? Nothing. All right. Quick slide, 5 minutes. Take a look at the committed traders. Committed traders still showing shorts covering, long selling. Market's still kind of liquid inside of here, and monthly maps are showing a bullish month. So still monthly maps from yesterday at least are looking good. Hold on one second. Figured something out here. There's a drawing. Found out the monthly maps do that. Somebody said click daily. Somehow the auto switch is not firing off for some reason. There we go. All right, so monthly maps are starting to show a particular setup here. The bull side is starting to come back. You guys see that bull side right here? The bull side bottom is starting to get lower. The bear side top is starting to go lower as well, and they both point down. That can be fairly, so bull side slipping down as longs accumulating. Bear side slipping down as bears short squeezing. Baby. We got everything looking great for the bull setup going at monthly expiration. This could be a choppy whatever, and of course after Friday, we'll get a clearer picture of the next month. You tend to look about a month and look a month ahead of you and then up to the iron wall. But you can see there's some manifestation even months out already. The bear zone used to be flat, and around here it's starting to deteriorate again. So it basically means this consolidation phase, low volatility environment is more likely to squeeze up on a short squeeze than it is to sell off, because there are no bulls really selling, as we've seen like lately in the monthly maps are implying that they're buying. So I'm excited about seeing this market move up a little bit. Yesterday's trade plan was kind of wonky, right? Resilience with the redistribution zone was up here. And this is actually showing. Oh, that's okay. That's showing today's. This is spreading for today. So redistribution zone was up here yesterday. And it was trying to break head shoulders for positive resilience. So it was fighting that fight. And once we got there and VIX hits a support, anytime I know I'm in a bull trade and VIX can go higher, I usually close a position. That's a trick we teach. That one of the best tricks we have to walk away from something early, to not take a massive loss or kind of wait on this. The market fell. Some people long from hedge pressure to hedge pressure. That was a great setup as well. People did this to this and people shorted from there to there. There's a lot of winners yesterday in our group. Papa Bear goes from here to here and just close down, call it a day. I try to get my trades in for the first hour or so, or two, because then I get busy for the rest of the day. Home sales today. That's right. Housing starts, right? No, existing home sales. Housing started from yesterday. Make sure I get that over here. Oh, today is Thursday. Okay, let's talk about the continued jobs claims. Jobs claims get mid to low market opens. Let's analyze those in a little bit. That's going to help us figure out what the Fed's going to do. Never trade VIX futures? I don't, but you could. It would be the same thing. You'd have to use an ETF that has a liquidity map like EVXY and just trade VIX futures off of that. I would day trade only and not swing trade VIX if I were trading VIX. VIX is its own animal that doesn't necessarily like trend easily. So, you know, you'd be scalping. All right, market, let's go. Market's opening. Well, let's roll. $57 on res. Okay, we're looking pretty okay here. Outside of the box. Lovely. Okay, let's see what we got here. 82. Okay, let's take a stab at it on this red candle. 71. Oh, that is strong. 90 something. Oh, okay. Okay. Let's see if liquidity maps come in strong. Hold on. That's great. That's great. And kind of like the whole gap and go situation. That's not a terrible idea. BC to hedge pressure 10 to 1. Oh, limited upside today anyways. Okay. Okay. And 37. Okay, so here to here. Maybe I should make it extra short 432. So whatever trade from here, I might short it to there. I might play both sides today, so we're going to be ping-ponging for expiration. Where's the liquidity map in here? So QQQ. Check that really quick. Break looking all right. QQ in the same boat. Oh man, limited upside today. Let's see the catalyst, see when they come out. I'll check a couple more things. Same shit as yesterday, guys. Literally the same. If we move up too high, well, actually, no. Sorry. If the market moves up here, VIX is here, and then we're probably going to turn around. So I might want to long and take a short if I can. Hedge pressure. I'm not betting that we break. And hedge pressure on monthly for VIX is like right there. So any upside, VIX really can have unlimited, potential to sell today. So we'll be a little cautious on this one. We're close to bull zone. Yep, you guys nailed it. So it's gonna be just like yesterday. I'm gonna be prematurely evacuate. That's a play on words there. But seriously, yeah, a little bit right there. So this is a really tight trade. I got small position here. I'll go to there, exit out. Hedge pressure break would be rare, rare to break. And of course, bull zone roll would get us back here anyways, right? DD roll. DD and hedge pressure roll right up there. As long as rest stays positive, we can stay outside the box, right? Rest greater than 0. Ideally, I'd like this to dip and I'd load up and trade it back to there. So I got just a small spot here. 65 big ones. Buy me a steak dinner today. VIX has some awareness issues right here, or as I have some awareness, it doesn't like it. It doesn't like when it's, bouncing. So that can open up the path for more volatility. This would be an interesting setup. When we get here and we're not irrational, that's going to be very important. Keep an eye on resilience, keep us floating higher. DD is still coming in pretty strong. While we're waiting, okay, we're at the box one more time. Good. Let's just put a little bit more. Let's do half my normal position. Okay. Let's read some of the data real quick. This is the housing starts. New residential construction typically, starts. Depends. This is noise right now. It hasn't been in decline for a little bit, due to inflation. We overbuilt, and it's a good secondary market. There's a lot of reasons new housing is kind of slowing down, but it's not really too bad. And here's one of the things: the continued jobless claims are starting to tick up, which is interesting. It was in decline, inflation was going down. Now it's ticking up, inflation's going up. Back to that same old problem we had before, like little secondary waves of this. And initial jobless claims are down, which means it's not new people getting laid off, right? It's not like new waves of layoffs that are stacked on top of others. This is people getting their jobs back. This is people from each week not getting the new jobs that are available. So it's like a problem that's compounding. Continuing jobless claims ticking up for a month or so. So not the best. So it means the hiring spree is slowing down. A lot of people need jobs. There's a lot of jobs available, and the results are showing that. With those available jobs, there's not a lot of people connecting with them. So either the mismatch of like labor type, or people still want too high of a salary in a period of inflation, and companies are now starting to put down and not want to pay it. It's finding them harder to find a suitable candidate. I think that's the thing. So it comes down to people can't go to work. Maybe they want too high of a salary, and companies don't want to pay it, and they're waiting for a better worker. And so what's the solution there? And companies need to pay less, or people need to want less. Same stuff. Divas, you're slow today. VIX to close, bull zone. Yeah, I'm like watching this like a hawk. So essentially, inside of here, I want to trade inside of here. Res is still positive. There's no irrational signals. Half gap bottom of the box support is not a terrible idea. That'll put us about, let's see, 4370, 4020, about 5 points lower. I'm going to play. I'm going to do my other position right here. We dip. It's like $200, $300 if I go there. If I dip in here and res is still positive, which, come on, we're losing. We're getting right at zero. There's the bounce point if we get it. There's a half gap bounce. Let's double check Qs really quick just to make sure. These are good. Y'all smash that like button, friends. Give me some love here if y'all like that. Stream. My cat comes in every day to remind you to click the like button. That's what he's saying when he says meow. That is one of those. Here we go. Now my question is, no irrational signals or as here. Oh, that's one thing too. These are going to be kind of like a limit here. And this could be a quick loss on this one. Let me see. Res is going to fight at zero. Let's see what we got. It's limited upside, so that's kind of the crummy part. I would like to short from a higher high. I don't normally short, but this could be a good setup from here. Plus, Nasdaq is kind of limited. Let's kind of play the one more. Get some red candles. I'll put a little bit more on this. I'll take it. It's Nasdaq though is flexing the bottom of the box. So we're gonna have some weakness on NASDAQ today. Range setup. I was hoping we get a little more bump on that. That res is pretty high out the door. It was nice. That is correct. It's not irrational, it's caution, but yeah, it's like the day pretty much is over on the kind of upside move on QQQ. It doesn't mean we can't trade to it and tap it again or trade to something, but you're right. Usually on S&P, if it touches the DD band, it's yellow for the whole day, so I trade a smaller position than I normally would. Correct. Yeah. You are right. Andres, can I please show you how gold, silver, Bitcoin's on the platform? Gold, silver, and Bitcoin on the risk interval list. You go here and you have gold is GC. There's gold. Silver is SI. Andres. And so if you want to look at like liquidity maps for these things without a futures account, you just have to go into, I mean, there's instructions on some of this in the futures section. What you do at the Discord, so what you do is you just look at the available ETFs that match. Like GLD is a great one for gold. You find an ETF that has options, and then that's it. So you would use the liquidity map for GLD. Yeah. So there's a like equivalent ETFs that you use. The futures conversion, there's an entire, like you guys, I'm like urge you all to go explore the Discord. All your questions can be answered. We have literally answered everything there, I promise. There's a whole Discord channel dedicated to your question. Actually a whole community inside the community, Andre. It's called the Futures Conversion group. And their whole existence is because they're futures traders and they talk about this entire thing. So there's a lot of great folks over there that can help you out. But they have every morning they talk about the conversions between like futures and the ETFs to go with them. It's a great group. Hoping for a better morning. Llama face close out trade lost. Power line went off. Had to evacuate. Oh, dude, I hate that. I remember I used to live in an apartment. And it was one of those like mid-rise city apartments, and all that you're walking through it's internal, so you're walking through the hallway with the and it's like deafening loud. Are you back? Stream lag? Oh. Res is still looking all right. I mean, still hanging in there a little bit. Look at some breakout plays today. Hedge breakout. Let's go this way. DIA looking good. Oh, Dow Jones is doing some things yesterday too. American Airlines, that's recent. Take a look at some of these things. Oh, hedge should break to the upside. Kind of looking good. There's only 8 stocks on hedge should break up. We also have monthly hedge breakup. See if there's anything going on there. A little bit bigger on this one. SQQQ looking like it's breaking monthly hedge. Not the best setup there. Any big dogs here today? TLT, American Airlines. Still got a decent res here. I don't hate it. All right, let's get in right here. R&R is a little bit better on this. Res greater than 0. That's what I'm looking for. I'm going to dig this one a little bit and have some fun. The rare case would be to break through the DE side now, so we're going to do this. Res greater than 0 on that one. But limited downside too. If res is less than 0, which is here. We're probably going to go this way. Had that kind of same like algorithmic push. So we got monthly expiration coming through on Friday, right? So we've been seeing some balancing act, and you know that this also happens whenever you get closer to monthly expiration. You start to see monthly hedge fisher and price get really close to each other with no irrational. Yesterday we had irrational signals, so it wasn't actionable, and plus it was after 2 p.m. when they actually bounced. Today, as you see, we're far enough away from it now, but the monthly res is still positive, which does imply a bullish close or a bounce there. So today, I would be very, very, very surprised if that were to break. So I double down at the bottom of the box with positive res that we can flex through the box and trade. And my question is, when I get there, do I take profit, or do I be a little greedy and hold the hedge pressure? And also on this one right here, I think we're more likely to do that than anything for the day, but we'll see. We'll see if anything changes. All right, what are you guys trading today? You got 1,500 on your Amazon close from yesterday. Yo, bro, good job. Likes incoming. There he is. There he is. There's my boy. Hey. Here it is. Here he is. Here's the cutie. Hey. Just in time. Everybody's waiting to hear you start meowing. That's right. We have 2 cats. This is the needy one. There's one that don't care about anything, don't like people. Somebody comes over to the house, he runs and hides, like completely that kind of cat, like scared, like bloody murder scared. Then he'll come out every once in a while and like be cool, like he bumps your fist with his head because he wants you to pet him, real aggressive, like pet me. If you get too affection, he like pulls away and runs. He's like, just scratch me, I itch. Don't make me like it. It's very functional. It's like, this is where I itch, scratch it. And if you try to pet him or if you like lean in, like nuzzle, it just literally like just runs off. Interesting personality. This one right here, I don't know. He's like a baby human who just, a baby toddler who just follows his mom around all day long. Meowing, mom, can't go anywhere. He's funny, and he's like completely fearless. Like you could literally like dip him in a bathtub of water, he just would be chill. We were like, I should turn this into Instagram cat. People do Instagram cats for like millions of views. You do anything to this cat, he don't care. He's just the chillest thing ever. Like when I'm up in my garden and they're both sniffing around and like chewing on the plants and stuff, I'll just stomp my foot and be like, hey. And the other cat, the scaredy cat one, will just run. Like he's like, oh my God, and runs inside. He'll just sit there and look at me like, what? And I'll like get closer and I'll step my foot in. I'm like, hey. And I'll be like, what? It's so like I'm bigger than you. I have the ability to destroy you right now. And I step my foot again. He just goes, what? I don't get it. I'm like, I can't be mad at you, but stop eating stop eating the leaves on my cilantro plant, literally. Yeah, like I'm in the middle. I mean, we still got, it's the same as yesterday. We've got the resilience hanging in there, still looking okay, and I'm looking for this, so that's the thing I'm hoping for. Yeah, it would be nice to see a bigger stretch on here. Now my question is, if I do take a loss to here, will I be willing to hold and trade back up? Probably. And the thing is that I'm being a little aggressive on this one, but we'll see. So right now, Rez is the flip-flopper there. DD still hanging tight and good on this one. And the thing is that today, everybody remember from yesterday's lesson, any upside move today, again, we bump into that same thing with VIX. What do we do? Everyone in chat, type really quick for all the new folks here. What does Matt do? Anytime I know VIX can bounce from something, what does Matt do? What do I do? What do I do here? Anytime I know I'm in a long trade and VIX can bounce, I always scale or exit. I usually exit, right? I usually just don't get greedy if I'm in a win. So if you're in a short, this is an ideal time to bet against the market as well. So like if I know we're going to chop today, I might actually do what I don't ever do, which is flip flop. Like if I get some long play here, I might take a short scalp to there. There's a little bit bigger spread. I could commit to it. It is 3-1. I do believe in the market closing bullish. My whole fear of doing that would be that I actually get a hedge break against myself on that. But here's the thing. QQQ is around the edge of being irrational. We're kind of near its own DD band, so it could squeeze pretty hard, but VIX would have to kill monthly hedge pressure and keep going. So I don't think the market is bearish enough for me to short, so I might just kind of like stay out of that one. Run and hide and trim. That's right. That's right. Man, I love it. You guys are learning more and more every day. Y'all are killing it. As you do this, after like a week or two, do you realize how much easier it gets to do these analysis in the morning? Not too terribly bad. You know, you have DD, resilience, liquidity, map, keep an eye on VIX. I mean, that's literally what I do every day. It never changes. I make a career out of this. Even on a small account challenge, you know, just growing a small account to show you guys how to scale positions according to account size. Oh, Anne-Marie. Y'all are super sweet. Y'all are so sweet to me. Don't lie, you're here for the cat. Y'all don't want to listen to anything I'm saying. Y'all are here for Fuki. Named Fuki after Fukushima, the nuclear power plant meltdown. Yes, I'm a huge nerd for weird shit. Dude, I'm so allergic to cats too. That's the thing. I'm super allergic to cats. That's why my cough is still around here. What do I have for breakfast? It depends. I'm kind of going through like a health kick right now. By the way, I've lost 13 pounds since I've been on my journey last 3 months. You know, the doctor said I had high blood pressure. Getting old fucking sucks. So, you know, losing weight, eating better. I'm getting in tip-top shape now. But for breakfast, so I'm usually eating a protein bar, I think thin bar, sugar-free, high protein, just something to put food in my stomach so the coffee didn't make me jittery. Or sometimes eggs with cheese and like some avocado, something like good like that. Or lately, like Jimmy Dean breakfast croissant sausage egg sandwiches. I bought them at Costco. Quick and easy for like something hot. And a lot of calories in those things, like 400 something, but that's a meal for a day. You don't have to eat lunch with that bad boy. Kinley's trying to have a meltdown. Yeah, the other one is the one that melts down. For the funniest thing, for his name being Fuki, is like he's not a meltdown. He's not dramatic at all. He's super chill. He's just needy. That's why I took on my throat. I think that's where it comes from. Like my sickness that I had, my cold I had, turned into allergies. There you go, baby. Let's go. We're getting that top of the box trade. Kind of somewhat back in the green. It's like, ugh. I did add. We're at the top of the box here. Rez is still losing a little bit of steam on that. My confidence is very low on this one. So it's going to be just random from here and see where we go. I mean, it's hanging. Not really scared of this. Nasdaq's trying to lose itself here. Is the same itchy cough for a month. I know, right? It's just like tickly. And I don't know what it is. Maybe it's the dryness. The air is getting colder. Who knows? Hear the rapper every morning. That was Little Debbie Cakes. Oh, this thing? Yeah. I guess I thought my noise gate on my mic was set a little stronger, and now it's I probably since I reformatted my computer, I haven't tested my sound, so maybe you guys can hear every little detail now. If allergic, wash your cat, hold by scruff, use warm water. Oh yeah, that's a great idea. like Simba, like when he gets into my stuff, I have a spray bottle, and like I know if you like spray cats with water, it can traumatize them. They hate it. They really hate it. So I spray him on his paws, like not his face or whatever. He just gets in. He's like, "Rah," and he runs off. Fugi, you literally, I bet you can like hold him upside down in water, and he would just float and be like, "What's up? What are you doing?" Literally the most chill cat. There's this cat Instagram that like literally when you look at one thing on cats, the algo rewards you or punishes you depending on how you feel about it with cat videos forever. And so like there's this one where this family has this cat and they do like spa stuff. The cat is so chill, like it lays in a bed and they put cucumbers over its eyes and or like wrap its head and the cat just lays there and listen, this is millions of views. This is how you get rich in life, okay? Cat videos. If you're gonna be like that, you could probably just like lay him there, put him in a costume, paint his toenails, raking that money. Yeah, I should be thinking about the news coming out too. We should probably take a look at where we got on the calendar here. Existing home sales. 4 minutes on that. Here's the thing: my risk, or the range is so small on this. I think it can be a mover. The question is, normally I would close before an event. This is an event, but this isn't like a breaking event. Hey. See, I just snap my fingers and Simba runs off. Yeah, don't chew on that electrical cord. You're gonna turn into a scene from National Lampoon's Christmas Vacation. These cats, I seriously like. I have these. They like to chew on electrical cords. I got a lot of them in here. EWD. Let me catch you after the event today, okay? Yeah, I should probably watch the cat though. It's a good idea. If I were to take a bet, that's why I'm in the mode of taking a bet because my greater thesis is bullish for the month. Now Thursday and Friday tend to be very volatile and very chaotic. Into monthly expiration, they can cause big sell-offs and hedge pressure breaks. Like yesterday could have just been a teaser, what the market wants to do into close. But I very much feel by Monday we're back to rallying, and I do think we challenge highs by the end of the year. I think that all signs are kind of pointing at that. Positional data is looking like that. Our executor monthly map showing it. Committed traders and futures and SP side show that the market's too liquid to crash. You have the two sides kind of tapering into each other. That's always a good sign. Oh, this is a 2-week-old data point. I think the new data point's going to come through showing some buying. But shorts are still covering enough to prevent a total meltdown in the market. So, like, I don't see, like, a pending crisis or anything soon. So let's get ready for the new existing home sales coming through in 2 minutes. But, yeah, so back to analyzing what the jobs claims are doing quickly. Like today. What the hell? All right, we're back. Oh, that was weird. Firefox crashed. Now, here's the thing. My browsers are crashing. It could be that I have like a million tabs open. There's something going on with like the memory of my computer here. Hi. All right, we're back. Give me a second, guys. I had like a browser crash here. Something is going on. Maybe I got some bad RAM chips or something. They're going bad. Because I have like really nice DDR5 RAM. I have like top of the line stuff. And normally I never had issues. But lately, there's been a lot of memory issues. I don't know if it's a Win 11, just a bad update, or I've got some bad hardware. I'm about to start going to the bad hardware and swapping out my chips. See what else I can find. Well, it's not no, but Rocket Scooter didn't crash though. It crashed. My Firefox crashed, the one that's running the music and everything else. So that, and then and then IQ on my computer crashed. Now I'm having apps crash on my computer, which lets me think that there's some kind of configuration error, totally like something going with memory, or like if like bad memory sticks, you're gonna start seeing some weird artifacts like that, things just crashing randomly. And I don't think it's a rocket suit problem, because everyone in our diagnostic team is checking, and they see the Windows 11 has a commonality with Edge, but I don't know if this is triggering the other things, and that could be like there's a memory leak somewhere, and basically just, and I'm watching my diagnostic, doesn't seem like there's anything there. It just spikes and dies. So who knows? Okay, let's keep an eye out on this one. Got the data coming out. It's 9 o'clock. Let's go. And I do have a million tabs open because it probably could be it too. Maybe I'll try. I do have Firefox and Edge combination. Maybe we could try doing everything in Edge. All right, let's look. Oh, wrong thing. All right, come on. News seems all right. Oh yeah. Let's come on. Where's the reload these tabs here? Kind of coming in decent. All right, we're back. All right. See, I'm still trying to find the smoking gun of what's going on. I'm watching like my diagnostics. There's nothing going on with my memory, but my computer just started having apps crash randomly. The only thing to do with Rocket Scooter has to do with I don't know. I'm gonna swap out. Oh no, I can't. I don't have other DDR5 sticks. So my new machine was a DDR5 build, so I need to go buy some, just to see if I'm having some, like a bad RAM stick could be like part of that. All right, be back. Oh, and now the trade's going down. Fuck my life. See. Well, I mean, resilience is still in there, so let's just kind of chill on that. I'm back. So my computer just rebooted. And that's so weird because I changed nothing. Like when I built my computer build last December, like I had this really badass super computer build. I mean, it's like 2 machines in 1 box. I mean, it was really nice and really stable. And somewhere in the middle, it just started getting weird. And I have no idea. The only thing I did during that time was update to Windows 11, and I didn't change anything else. And then at one point, I woke up and my computer started freezing in the lock screen. Like I have nothing open sometimes, and I just wake up, my computer's frozen. Well, it's locked. And then I'm like, okay, maybe I got a virus, or maybe something's going on. So I reformat, delete everything, start from scratch, and then the same thing's loading up. So okay, it's not a virus, it's not a thing like that. It's got to be some kind of a hardware problem or hardware configuration problem. Windows 11, and I think that it could be a Windows 11 thing, because Windows 11, that's the only thing that changed. Like I didn't change anything. I didn't install anything. My computer is very bare bones. Like I don't do anything else but work stuff on it. So I don't have like random stuff on it. I mean, I search my naughty websites on a different computer. I don't even do that here. Literally just work. Browser, spreadsheets, Google Sheets, streaming stuff. So there's not a lot of conflicting software or programs running in the background. It's very light, and computer's top of the line too. So it's not like it can't handle the stuff it's running. Also could be Discord, because I've been having a lot of issues where Discord just freezes and crashes, and they've had some updates too. Something is like just spiking the memory use, and then everything starts destabilizing and crashing out. I don't know what it is. It could be Win 11, because there's a lot of people that report in tech support the Rocket Scooter like, hey, I get this out of memory error in the browser and Edge, and we find out that pretty much everyone's in the same boat. Win 11 using Edge. So I might roll back to Win 10 and see what that does. Too much? Wall Street past the loss point? Yeah, exactly. So anyways, but yeah, that was blue screen. But I know earlier, like I was sitting here running, and then IQ crashed, just Corsair. Resilience is still good. It's still okay. Let me test something out. Let's add. Resilience, I hate you. Yeah, I know sin definitely happens less when it does to you on your stream. Yeah. Well, one of the things is that we're also pioneering a technology on the platform that nobody's doing as well. And one of the things we're investigating and looking to see is how our process works. So you know what, Rocket Scooter is different than everybody else who has a trading platform. So imagine like Netflix, right? Netflix, you subscribe to Netflix, you go on there, you pick a show, and then they just stream the show to you and get the show streamed to you. We stream indicators to you. The calculations are done server side. So this is a brand new process, and it opens the door to our new business model, right? And what that is that anybody can program their tools or indicators in our ecosystem. And the calculations are secure on a server, and so you can broadcast the proprietary portion of your output through server calcs. There's really does two things. Number one is you go to like TradingView, for instance, and that client side calc. Number one is they limit how many outputs that you can have when you code. So like you can't send a very complex tool to the front end because they don't want to crush the experience on the front end. If you do a lot of browser calculations, that's heavy calculation load and the platform slows down. Our calculations are server side, means the platform doesn't slow down with heavy calculation server load. So we do the calculation as server and broadcast the outputs forward. So you're just getting a stream of data that's drawing. Like resilience is streamed to you. It's not calculated here at the browser. We're just streaming the data to you and compiling it on the downstream. So that technology is great because a lot of people are interested in our marketplace because they can take their proprietary algorithms and code them. Not only can they have the safety of it being on a server, but you can calculate faster, unlimited outputs, unlimited charting. You do all that stuff with Rocket Scooter. So you have a tool you want to make and you want to sell it here. We're not going to limit you to like the number of charts and you have to pay to open up more charts. A developer won't have limited outputs on the front end. They can literally code to their heart's content with the most complex things in the back end. And those are the two biggest pain points that people have when trying to, sell their tools. There's not really a place to do it, and then they get throttled by the ecosystems they join. NinjaTrader is one of the worst ecosystems for this. You only have so much you can do before you start. And I love NinjaTrader. No, nothing against them. It's just the technology. There's only so much you can do to where the platform starts to lock up. It just can't handle it as well. And those calculations are done locally on the user's machine. TradingView, it would happen if they didn't limit the creator. So the creator is limited by the number of outputs, and that keeps the platform from locking up. Platform-side calculations, especially in a browser, can freeze up really good. And those are both two great technologies with good marketplaces, right? But we've just taken a step above their pain points with server calcs. Oh, my trade's finally hanging in there. Res is negative though. Fuck this. Fuck my life. Okay, let's just start trimming. At least the top of the box here. Just a little bit of profit on that. So in this optimization process right now on the front end, we're trying to optimize to see, what we can do for like streaming data and server load and stuff. And one of the things that I think could be draining the memory is the scanner, because it's sitting here, like I have loaded up, there's 500 tickers active streaming data, and that could be one of the pain points. So we might introduce something just to test out, like the scanner returns the top 20 results, and you can click to load more and click to load more. That way everybody's not just opening the water hose on the scanner. Turn back in the stream. If I'm hearing this right, Rockstreet's expanding down the road to help build algos for other people. Parp, let me start over. Yes, and we're not down the road, expanding now. This has been our project for the last year. Kind of been planning and doing this. Got really heavy in the summer and secretly building what we're building. We're building the world's biggest trader marketplace, period. You've got 30-something vendors all ready to sign up out the door. Huge vendors. We got a couple A-list vendors ready. We're building white label platforms for people. We can build your own algorithm for you. Similar to how Rocket Scooter is its own platform, I can build you your own platform. That's one of our major business units now, is we can white label building you widgets and tools inside a platform, scanner alerts, whatever. We build exactly your customizations. The other thing is that we're having what we call our console, which is your ability to input your indicators into our ecosystem, and people can buy your tools from our marketplace and add them to our platform or add them to your wide labeled platform. Either way you want to go. You have a vendor feature page on your marketplace, which can have your trade room, your Discord, your newsletter, your alert service, all those things. We're going to have like this kind of like connection portal where all your stuff is connected together and people can buy these products free in one marketplace. Did I go to college? I absolutely went to college. And then from here, so the idea is that it's going to be a network of just traders. We have a lot of people ready to sign up for it just to kind of be featured on there. But the idea is that we're going to have not only just it's like the Amazon for trading, but it's also going to be a very collaborative, fun environment where everybody's we're showing off different folks, featuring new tools, and you're going to have much more ability than just coming on the Rocket Scooter. Just use Liquidity Map. Reminds me of Tesla, not just a car company, Rocket Scooter, not just a trading way. Will language will be supported? So for coding in our console or our environment, we're going to create our own coding language called Rocket Script. It'll be a trading language similar to a Pine script or Think script, very similar in that it will interact with trading candles, and we'll have a very good documentation, easily get on there and do it. And what it does is you'll code in that language, and then we'll have a translator that will automatically turn your code into server code. So it takes your simple code and converts it to server code, like Python, and then we'll run your calculations on the server and broadcast them forward. So as we open up that market, if you guys have tools, I mean, anybody can come on and become a vendor and sell any tool they want. If you have an indicator, you want to, and basically the pain point is you walk right in and you can start your trading business tomorrow. Whatever it is you have, books, newsletters, and you see, come on, resilience. I'm glad I trimmed a little bit, but I still have position here. So people can make a tool with very little programming knowledge. So the two ways to go about it is, number one is you can, on RocketScript, market hates me today. You can program your own tools on your own Rocket Scooter platform just to have. So now you can start bringing your custom scripts over here. Like PineScript, the trading view is not something that comes with their white label, so we can't just use PineScript. You have to convert any other indicators you have elsewhere to like your own script, but you'll be able to save your tools in your local version of the platform by programming locally. But if one of our clients wants to join what we call our console program, it's some cute names for these things, but we'll release them when we release them. The console is an environment that you log into and code your stuff, test it, then deploy it on the server. And then everybody that subscribes to you will have it in the indicator list when they buy it. They're revolutionizing this whole marketplace thing. It is very, very, very cool what it's going to look like and what it's going to do. It's been the dream of mine since I started building a platform that it's not just to be focused on my trading style. Like other people and other friends of mine that use Rocket Scooter, they love it. And then they use their own platform and their own style. And it's like, how do I get my tools and your tools? And I'm like, just wait, we will do that. So I went to college. I studied chemical engineering. I was third in my engineering class. And I worked as an engineer for a little tiny bit until I got laid off during the last financial crisis in 2008 to 2010. And then I started trading. Can you be a beta tester? We could. Send me a message in Discord. Do you work for free for a terrible boss who's kind of sometimes funny? He has cats. Come on. Don't hate me so much. Trade. This is just a mad day. See, we're kind of getting there. Why am I long now? Just because I'm thinking about trimming. Another thing is that I do have support. Still here. To break monthly hedge pressure would be rare today, just because this is positive, right? And that meaning that if monthly hedge pressure is positive, I am expecting a bounce there. I trimmed right there, as you guys saw me. I should have trimmed a little bit more, but I do have some buying power to kind of long right there and still scalp out here to bring flat if I do. So I'm not gonna do anything here in the middle. Res is negative, so we could reject the box and fall a little lower. So let's go ahead and let's just be very, very careful here. Trim a little bit more. Okay. So made some profit, just took a couple loss. Now I'm in half of my position, so I can actually double down at monthly if I want. So I'd like to get that monthly trade here to hedge pressure. That would be a great close if I get that. So essentially, I'm kind of probably sitting flat for the day right now with the position in case we go here. Does someone want to be long on MHP just like yesterday? I have plenty of room to move if volatility consolidates, so I'm going to dive right back in at MHP. All right. So yeah, our marketplace that we're releasing is going to be massive. We have so many people in the industry already supporting the idea of this. We're going to have everything there from when we launch, we're going to have trader funding programs already there. We're going to have some of your biggest and best trade rooms, some of your biggest and best indicator sellers. And we're going to launch with a marketplace of millions of people already. Some of these communities are just massive. And When is Rocketeer going public? Not going public, but if you guys know private equity firms that are issuing Series B funding, Daddy's looking for 20 to 50 mil to expand and saturate the market. So you know. Let me know if you got buddies in private equity. We're at Series B stage right now. Oh, man. Oh, darn. Here's a monthly hedge. All right. You want to play risky here? Monthly hedge resilience is positive. Let's not bet on hedge break. Let's go ahead and tap that. Your VIX-Y isn't showing. VIX doesn't show bullish or bearish. You got to be careful on that. VIX just shows volatility. And while I don't have a volatility pivot in front of me, VIX can go up. So what I say is that while VIX is slightly going up, yes, volatility is slightly expanding. There's your small V and a bigger V. Now, a monthly hedge break would be nasty. This is something I want to see not happen. But with res less than 0, my exit target is there. So from here, this is I'm trying to turn a loss maybe into a break even or a win. I want to see that trade right there with a essentially a 1. I might do a 0.6 stop there. So essentially what I did was I longed, took some profit, let it fall, then I longed again here. You'll see how this works. Took that trade to there, didn't work out. Took some profit there, and res was kind of sitting kind of meh. And then now our monthly hedge pressure, monthly hedge resilience is greater than 0. With no irrational signals, like excluding SPY hedge break itself, there's no irrational signals yet. So when there is no irrational signals, monthly hedge resilience is a pretty decent indicator for the integrity of monthly hedge pressure. So hopefully we hang in there, and that's what I'm looking for. So I added to a position here, but breaking monthly hedge can be devastating. So I'm not gonna let it lose a lot if it does. Hold on. I'm gonna go ahead and bail out if it kills me any further than about 429 will probably be my limit. And about here. Why'd you ask if I went to college? Perp. I studied chemical engineering with a subspecialty in reaction and reactor engineering. So reactor design and economics was my sub-focus. And my job as an engineer was working at a plant, and I ran chemical reactors in Dow Chemical. Acrylic acid oxidation reactors. We made diaper absorbent for Huggies. Papa Bear don't like. So just run these massive reactors, and stuff would come in, stuff would come out, we distill it, have your product. Reactor, I ran 3 reactor units. Each one of them is a giant chain the size of half a football field. And they're these gigantic, and one of the technologies was built in the 70s, 2 of them were built in the 90s. So the one in the 70s was these like short, fat things that had 25,000 tubes in them. I remember top of my head how big this was around. It's probably about 25 feet in diameter, not like 3 stories tall. Those fun days. Your mom goes to college. In college, I did research. It's far not. I had 3 jobs in college, actually. One of them was Domino's Pizza. I was an assistant manager at a Domino's Pizza in my hometown. That's why on my textbooks I have pizza sauce stains on the margins. So I used to actually like work the oven, answer the phone. So I ran the little store at my house, and I would, oh damn, dude, that's not a good one. This is a risky day though. We're on the edge where I want to bail on this. I hope we got a couple of seconds, and I'm just gonna start trimming. I did double down here at monthly hedge, so let's see how this works. But I used to like I worked at Domino's and I had research, and then I taught at UMH as a student teacher. So I taught fluid dynamics and material science engineering workshops. Those are my 3 jobs. And my research is cool because I worked for the head of the department. There's one like limelight research role for an undergrad to work on the project that helped design the diesel engine catalytic converter, which was a global effort by a bunch of teams around the world, which was to beat the 2007 Clean Air Act that required high regulation on diesel emissions. So I get to work in the Schlumberger facility running giant 18-wheelers on a dynamometer, which is just a giant drum that spins in place and this truck drives in place. And our team was responsible for designing the recipe of the catalyst that simultaneously oxidize carbon emissions while reducing sulfur nitrogen emissions together. It's a very complex chemical process, and there was almost like an audition process for this role with everybody wanting it. Lucky for me, the top kids in my class were all pre-med students, had zero desire to do it, so I was like first choice, which I kind of got lucky. Like the people that had better grades than me, the two people that were like above me probably would have easily got the job too, but one became like a heart surgeon. So I had no interest in doing engineering research. I did. I loved it. I loved the challenge. So it was fun. Well, I've always been heavy coding like my entire life. So when I was 12 years old, I started coding in BASIC. So I was always a hobbyist coder. And then in middle school and high school, I was on the computer science team, so I competed in UIL coding. So I always did coding on the side as a hobby. Like I coded Pac-Man one time from scratch. That's one of my claims to fame when I was probably 14, 15. I coded a version of Pac-Man. Just for fun. So I was always fascinated with coding. And then in school, and especially when I got into the industry, there's a lot of opportunities to shine if you're good at coding. If you work as an engineer and you get this complex dump of data from a plant, and I would write my own tools to analyze and crunch the data. If your job's optimized or something and look for trends and figure problems out, it's kind of what we do in the stock market. It's literally like the same job. So it's a lot of fun. But when it comes to coding, I'm not a trained coder by any reason. So I didn't press my knowledge base into modern applications, JS type applications, Next, React, things like that. I hired people to do these things. So in modern applications, I don't have a lot of background in that, but I can stare at code and figure out what it's doing. It's like I have just enough knowledge to manage a development company. But the coders we have they're fantastic at what they do. Okay, let's analyze what we do. We're at monthly hedge now again. Do we hold? Oh yeah, but my college job was fun. Like the research. Actually, before I did that research, I kind of worked for another professor, but then the new professor kind of stole me away from him. The old professor, we worked in carbon nanotubes. It was really cool. We had atomic deposition chamber, which used vapor to grow carbon nanotubes like a plant. Like it would deposit carbon atoms one row at a time, like 3D printing carbon nanotubes in a deposition chamber. It's kind of cool. And that was fun for a little bit. But my love wasn't materials. My love was math and catalytic engineering is all math, and I like that. I like the hard stuff. But the carbon nanotube project's pretty cool. I did like looking at that whole process. 4360s, that was your target yesterday, huh? Yeah, that's the, I'm looking to get that today, hopefully. But yeah, I used to run in a lab. It's kind of cool. Like the lab I worked in, yeah, I was the undergrad, so I was just the lab bitch. You know, I would set up the experiments and do everything. The postdoc and the grad student were the one directing the project. So I ran all their experiments for them. Every day it was like, okay, here's the catalyst recipes we're testing this week. 60% this, 40% that, 58% this, 42% that. We could find out which one has the better yield under these temperature and pressures. All right. So I would like, have these two little, it's fun. No, we should focus on my trade here, but you want to break monthly hedge for sure. Do not like, let's stay here. Had this like machine that had these like two little crucibles on it. They're the size of a pencil eraser. One was a control, and you would basically like pack in your little powder here. You have like a crosswind flow that would blow vapors across it. We simulated diesel exhaust, so I had cans of like carbon monoxide, cans of sulfur dioxide, nitrous oxide. And so we mixed all these poisonous chemicals together to create a fake exhaust in a lab under a fume hood. Kill you in any instant, silently. Carbon monoxide, can't smell it. So there are detectors everywhere. Everywhere you were looked, there was detector, and sometimes those things would beep and the batteries went off and I'd fucking shit my pants and run out the door. Beep, 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 beep. 4 beeps was like dead battery. 1 beep was like run for your life. But still. Dad, we're a detector too. We had detectors on the fume hood. Anytime, so we had a double contained fume hood. So I didn't have to wear a detector, but the fume hood had detectors on all points of exit. And the lab itself had detectors near outside of each office and at the entrance to lab and exit to lab, because that way you wouldn't have stuff leaking into the hallway. So it was pretty secure. Actually, the scariest part of that lab was the fucking asbestos in the walls, because we had to drill holes in the walls and shit to set up our reactor. And I was always just more worried about asbestos, because we were always you have to get a specialist to go in there and drill a hole. It's a whole process to mount something. That was actually the real scary part. Got a 100-year-old university, you know. That was fun. And then so we would simulate this stuff and blow gas over this little thing. And the cool thing about it was these things were on these micro balances. It was this cool technology. And I forgot what the machine was called. But essentially what it does is it measures weight change of gas adsorbing AD onto something. Like gas will stick to things, right? And you're talking picograms. You're like trillions, billions of a gram change. So we're seeing how much gas sticks to the surface of a thing. And those little tiny little crucibles were so sensitive to anything. If you'd sneeze, your data would get a spike from the pressure wave in the air. So we had these no talking signs around. We put these signs all around the lab outside, hey, please be quiet outside the door. A lot of my job was going into data and curve fitting the noise. If there was a volume spike or a spike, we'd have to go in there and edit that out, because they're oh, okay. If I sneezed, I'd have to go in there and remove that spike. So I walked around the lab in my socks, and everybody did too. So we had to take your shoes off with the door roll. It's fun times, very fun times. So we came up with the perfect catalyst recipe. We looked at the reaction rates and what was the best. And then that facility with the giant truck on it, if we found a recipe that we liked that was good, we would call the catalyst company and get them to make us a giant version of it, and we would build that into a little catalytic converter prototype and then run it on the machine in the car, and then have the real exhaust from the car. So we'd be spinning a diesel truck in place and then taking the exhaust and then running it through some analyzers. So we were trying to find the recipe, and we didn't write a bunch of papers on it and stuff. That was hella cool though, because the project, made some major changes for the environment. Can't complain about that. Reducing SOx and NOx emissions tremendously. So it was a global effort. There must have been dozens of teams working on the same thing at the same time. It was kind of neat. But Matt loves his rocket scooter like he loves his chemicals in math. No, you're telling him rockets would be in 5 years. Oh, well, thanks. I do like making stuff. I do like building stuff, figuring stuff out. It's the art of the science. Like in the trading world, you've got your guru that's going to tell you they got everything figured out. This is how it is. This is the best. There's nothing ever going to beat this. I know everything. And I am the scientist that says I don't know everything. I like that know everything because it makes me explore and find out more stuff. Can't go wrong with that. I'm always improving and always making new stuff and always trying to embark on a new mission once I complete the previous one. The innovation is like what I love to do. Challenges, like figuring stuff out. Let's hang in there. So I think I made probably on my first close maybe $100 or so, and now I'm sitting about 500 down. Maybe I'm 400 down for the net for the day. Hopefully hedge pressure hangs in there. With res being negative, again, we have resistance here, so I'd like to see this hold for the day, and we'll just see how that works out. But I love golf. I don't play golf because I'm not any good at golf. And when I went to Top Golf when I was younger, I got drunk and injured myself. I was so drunk. I injured my back playing Top Golf like an idiot. That's how bad I am at golf. Boo, I don't like this trade. Not good today. I would love the aspect of trying to figure out golf. If I practice golf, I might love it. I like nature and peace and being like one with the environment. I'm very hippie like that. Golf is the perfect sport for a hippie. It's quiet. You get the birds chirping. The sun is barely out, in the mornings. It's just nice and quiet. That's why guys that I know love to play golf, because they live in high energy worlds. All my friends are either doctors, surgeons, investors. Their worlds are like so chaotic and heavy, and they play golf, and it's like, that's your peacefulness. I would love to figure out all the different parts of learning that game. That would be certainly something I would probably enjoy. But yeah, so that funny thing about in the lab, that machine being so sensitive, we had all these goofy rules, and like I said, it would take 8 hours to deposit enough gas on a we assume like a chemical reaction has a couple steps, right? You have to have the molecules find each other. Number one, there's randomness there, and when they find each other, there's an energy you have to overcome for them to react. So you mix two things together in a solution, the molecules are moving around. They have to bump into each other, and then once they touch, they have to have the energy to react. It's two different parts. And so which one's the limiting step we tested, which is the collision rate with the molecule and the catalyst. So that's why you're testing how sticky things were to the catalyst, how much gas could you absorb in a certain downtime. And to change something by that much, it took 8 hours for a nice little curve to develop to where you can actually create your curve like that. It's 8 hours of data, and then it's sneezes and bump the machine and kind of stuff. But the control crucible was to create a data set that would curve fit the other one. So if you sneezed, the control would also pick up a sneeze. So it's kind of like if people ever do filmography and you're recording audio, and where you're recording, it's loud. Usually you'll film an audio track of just the blank environment, so that you can reverse that out and undo that from a real live audio feed. So mixing the two signals together, reversing the other one, kind of eliminates equal and opposite waves cancel. So we would use the control crucible to cancel out sneezes and shit. So it was even so sensitive they wouldn't let me listen to music. I couldn't in those days, in the thousands, there was iPods. You didn't have a smartphone to jam music to, and there's no iPods rule, no headphones rule, no music rule. So it was quiet rule. When you get the free time over years, pick it. If it fits your passions, it'd be fun. I've tried to play golf before, and I know that I do like it. I just am not good at it. So people don't like playing with me. Even though I'm fun, I'm sure it's annoying that I'm not taking it seriously and other people are. So I don't get a lot of calls. I came out to play golf this week and you should come with us. Market's probably waiting for Pal. I would think so. Yeah. Just to tell fun stories about life. I've had a pretty interesting life. It's about an hour away. In 11 my time, 12 Eastern. I just have a hard time believing the market's going to collapse out. God, what a terrible. Yeah, and Res just kind of dies out here. Hopefully that we get something going on with Pal Talks. And even drifting below monthly like this and rejecting it a couple of times doesn't look so good. I mean, monthly Res is still hanging in there, so I'm not too scared yet, but I don't like what I see. Will we develop an MHP for the Russell? We've talked about it, and it's something that we need to. A part of our expansion project right now, an optimization project, is to be able to do additional things. Like as we open up our marketplace, you know, our core rocket scooter indicators use S&P and NASDAQ. That's what we built it around. Building out Russell tools, penny stock tools, crypto tools, everybody else go out there and build all these different things. We're going to need to expand further into our capabilities. So, you know, once we have the ability, the reason we don't is just because it's just another infrastructure project. We have to go create a new list, a new stock list for the Russell, and it's not a terrible thing to do that. MHP for the Russell, we never did initially because we just built our stuff around S&P NASDAQ. But it'd be worth having. We built a Russell resilience out of half gap resilience in Russell. But not all stocks have options. So the choice with Russell was, do we, you know, S&P gives you enough information about all the market. Russell independently trades, though. It does. And so it does deserve its own MHP. The one problem is the majority of the stocks in the Russell don't have options. So it's like a, hold on, see. So the question was, what's the integrity of the ones that do? Is that good enough? It wouldn't be the full 2,000 stocks. It'd be the Russell 500 maybe, 700, something, you know. So hedge pressure wouldn't be, like the reason we don't have hedge pressure resilience for the S&P and NASDAQ, like blue resilience, and we have yellow and white, is because not all stocks have weekly options. It's a huge chunk. 70-something percent, 75% of the NASDAQ stocks do not have weekly options, and 50% of the S&P stocks do not have weekly options, believe it or not. So as the years go by and CME Group releases like new option schedules for stocks, you should probably have weekly options for everything at some point. That would be different. But with half the stocks missing, we were like, well, maybe let's not make a blue resilience, like a tiebreaker. It'd be great to have, like you hit hedge pressure. What is blue resilience telling you? What is the probability that stocks are breaking their own hedge pressures? And so missing half of the stocks would be like, would that be an indicator be any good? So we've had that question for a while. Russell will be in the same boat. So that would be like the S&P, if we had a blue hedge pressure, like if you go to the status, you can see how many stocks have monthly options. That's what this yellow line is right here, yellow. So S&P, 92% of the S&P 500 has monthly options. 99.8% of the NASDAQ 100, so basically 100% have monthly options in NASDAQ. Yeah. I don't like this setup at all. Man, I am just not liking today's setups. We also have DD float. The problem is we also have DD float to hang in here as well. It's like, this is one of those days where it's not that. I should probably be in a smaller position, to be honest. I wouldn't be surprised if we did this and then that. This is a pre-expiration shakeout. There is no, I mean, like when we traded up here, we got down here, I trimmed, this should close out more. It's the same exact trade as yesterday. This is literally the same exact setup. Bumped up, VIX hits a pivot, and the market becomes volatile. And as the volatility hopefully starts dying down, if we get up here, then it's game over. I just have this feeling that we're here today. It doesn't, I just don't feel anything other than us connecting with that balance point. I just don't feel like this is a collapsing environment. Nothing points to that. Ideally, the reason I'm still in the trade because the risk and reward from here is really good. I might be down a little bit for the day, but this is what I'm hoping for. We can get plenty of run if float holds. We had float failure yesterday. Float. Res is bad, but it's not terrible. NASDAQ res is bad, but it's not terrible. And market's just connected with monthly hedge pressure as normal. VIX is not anything scary. There's plenty of room for VIX to move to there, which can get us back up to there. Let's look at IWM really quick. Yeah, good call. I know monthly maps just look good. I can't argue with that. This is true. Hopefully we're good here. I don't get this environment just yet. The environment spells bullish long haul. If it gets shaken out this early on, okay, that's one thing. This shouldn't be breaking like a repeat of yesterday's setup. The question is, do I want to take that? Just 10 more points? Jeez. That's another 500-600 drawdown. Well, I mean, this is still hanging in there. NASDAQ, I mean, they're all looking okay. But I think there's going to be the bear trap, and I have to hold through that. I don't like that idea. A little bit 500 more drawdown. Not my favorite. Although I should have noticed this today too. Like, I should have taken a hit with that. I wasn't watching NASDAQ. There's the NASDAQ hedge pressure limit there. I probably should have trimmed everything there, to be honest. I get so distracted sometimes in the day, I don't pay attention to everything. I really should put NASDAQ, SPY, and IWM up here on the charts. I agree. I think that that's appropriate for today when Powell's talking. That'll bring me to a slight loss for the day, or slightly green. Yeah, that's why I'm not putting too much stock in anything I'm doing. And Powell's not going to say anything other than his traditional non-damning light commentary. Watching economic data. Economic data is getting better. Inflation's still a problem. We're looking at the employment situation, wages. It's the same conversation. He's always going to say the same thing. Same metrics they're watching. Let's look at the top. Economic data is improving. GDP is growing. The hiring spree is stalling a little bit as continuing jobless claims are ticking up. So let's talk about that. There's a disconnect between companies are thriving and wanting to hire. Let's look at that really quick already. Let's try to forecast what Powell's going to say. These are engineering skills. Hold up. Let me jolts. So jolts coming down while continuing jobless claims going up. Let's just close some of this down really quick. Let's close out. I don't know what's like housing starts. So let's start over like this. Okay, so like over time, from like May until like a couple months ago, continuing jobless claims are coming down while jolts are coming down, which means that available jobs are getting filled. So basically companies had jobs and they were unemployed folks, and then the unemployed folks were getting jobs back, which means wages are coming down as they're competing with each other for the job. But now you have jolts going up. So job openings are up. So it's one of two things. Either A, people are getting laid off, or new jobs are being created. How do you know which one? You go to the initial jobless claims. The initial jobless claims will answer that question too. If it's new people getting laid off, if jolts spiked here a month later, then you would expect new layoffs if it was people getting laid off to free up those jobs. So in the new jobless claims, let's look at the last 4 weeks of data. Are there spikes here? And the answer is no. So if you're looking here, the new jobless claims aren't that big. So it's not like JOLTS went up because of layoffs. So therefore, that pinpoints one reason for this, and that is job creation. Ever understand? Narrow it down. Job creation. Let's repeat if you didn't follow, right? You're like, oh, this is really smart. Okay, JOLTS go up, which means there are jobs available. So jobs become available is either A, companies are laying people off and now you have open jobs, or B, companies are creating jobs. So companies are laying off, you would see, you'd start to see growing spikes in initial jobless claims. As a matter of fact, they are just down. Oops. So, case in point, we have job creation. Let's just say job creation. So companies are expanding. Great. They need new employees. Great. So that's good. But continuing even though initial jobless claims are down, continuing jobless claims are up. Let's wrap our head around this. Continuing is like people that are continuing to file, like they lose their jobs. Like here's the waves of layoffs, but then they go back to work. And this is the accumulation of total people filing for unemployment. And you see that a couple of months ago, they're also starting to inflect up, which means not only is there job creation, it's harder for unemployed people to get the job. So harder for unemployed people to get the job. Okay, so what's going on here? We have jobs, we want employees. Hey, we're employees, we want the job. And they're like, we don't want you though. We want someone else. So why, with available jobs and available workers, is there a disconnect between the two? And that's your next step. We're doing engineering here. Root cause analysis. What could be going on? Why are there fewer people getting their jobs back at the same time as jobs being created over the month? Let's kind of think about that. So it means that there's a disconnect with what each party wants. In any negotiation that is not reaching a conclusion, this is Nash equilibrium math. In game theory, when two people are not reaching a conclusion, it's because neither is getting what they want. Where's the compromise? Let's figure out which each pain point is. Job creation. Well, companies are expanding, and the thing on the surface is that workers want more money because of inflation, right? And maybe this is just the last part of the worker pool that are just kind of not great at their job. The companies were desperate during the post-COVID era to hire anybody they could. But now these are the actual folks who aren't really that good at their job for the money they want. They might have a $120,000 a year salary, and they're out there fishing their resume, and they're not going to accept anything less than 180 because they got that during COVID from their company before they got fired. And they're like, I want 180. And they're like, it's not COVID world anymore. We're not paying you the inflationary salary that you want. And the guy's like, well, I'm not going to take the job till I get what I want because I have an expensive house and car I can't afford. And so maybe the companies could be the biggest factor. Maybe the companies want to pay less and the workers want to receive more. And the companies are going to have to either A, pay more salary, or the workers are going to have to accept less money. In an inflationary environment, it's a time game. The longer somebody is jobless, the more desperate they get to not be behind on their bills, and then they'll take a lesser salary. So is this just a big game of chicken between an expanding economy that needs jobs? Okay, so what's expanding the economy? Let's look at the data that goes through that. GDP growth, right? Quarter over quarter is greater than zero. That is definitely bullish in the economy. So companies are not only hiring people, but they're hiring efficient people right now and actually making money because the stock market's going up. So earnings are going up and things like that are happening. So economy's growing and companies are creating jobs. So we've just pieced all that together. And there are unemployed people that can't get those jobs. And it's just probably still a battle of inflation. And maybe the company is just looking to expand, but they maybe don't want to expand at the cost it takes to hire mediocre workers at a higher salary. I think that's the biggest disconnect would be salary. What do you guys think? Let's figure it out. What is your opinions on that? What other reasons could there be job creation, but harder for unemployed folks to find those jobs? disconnect as well, or like labor mismatch. So the available jobs could be specific to a sector, and that sector maybe doesn't have a lot of people. Maybe those jolts are medical employees, and there's a shortage of doctors. So shortage of available workers in a specific job type because of labor mismatch could be the other reason. We have to dig deeper into that data and those job openings. What sector are they in? Is it in tech? What about the unemployed folks? Are they mostly tech? What if the job openings are hospitals and the unemployed folks are no doctors there? That could also be the disconnect. You could have one market saturated, one sector, and one sector in demand. And so it could be a spot issue. There could be certain sectors that are hurting and certain sectors that are thriving. And that could also be a reason, right? So what do you guys think? Oh, you're talking about T-ball actions seem to be volatile. Yeah, they have been. Somebody says you've been getting so much to the group, don't be hiring yourself. You guys are awesome. Parts of the Apex funding, you're not allowed to scale out of positions. I can scale them when I close. There's no option to close partial. I'm not really sure. Part about I remember talking to you about the funding stuff. I'm not really sure about the rule with Apex. You're not allowed to scale out of positions. What does that even mean? Like when you're in a winning trade, you can't close some of it out? I would think you would be able to. S&P monthly resilience moving lower, close to zero. I would think you would be able to close out positions. I'm not really sure. I'm really sure though. I don't know. I'd ask them. No experience with that particular question, so I'm not really sure. Somebody said building related, auto strike. Oh yeah, you know what? It could be related to a lot of the strikes. Do those people, when you strike? I don't know the mechanic. When you strike, are you technically considered? But unemployment requires you to be laid off for non-performance reasons to qualify for unemployment. So striking folks wouldn't qualify for unemployment insurance, would they? They wouldn't be in that data set. I don't know the answer to that. I'm asking. Right. I know the answer, that to claim unemployment, you have to have been fired from your job for non-performance reasons. Then you qualify. So that part, yes. So it's a strike. If you go on strike, do you qualify for unemployment? Because you're voluntarily quitting. So I don't think, on the surface, it seems like you wouldn't be part of this data in this analysis. You would be part of the problem probably, but you wouldn't be. The jolts would be missing your employment. Yes, but you wouldn't be in the jobs report data, the unemployment filings. Sorry, because you wouldn't be filing for unemployment, so you would fall out of that data set. Right. But jolts will still be missing you because they have a job that needs to be filled. So strikes, I guess lots of strikes could cause that. Lots of people quitting their job. Oh, that's a great thing. Lots of people quitting their jobs voluntarily would make the jolt spike. Strike could do that. But we wouldn't see what they did after that because they're not in the unemployment filings data. Good question. You have to set separate exit targets to modify stops. It's pretty annoying, but it's what it is. Part. You're talking about the Apex stuff. Yeah. God, the stupid market. S&P got dangerously close to zero on monthly RAS. So we're going to talk about what Powell's probably going to say, right? If I were just on the surface still lean on the idea that it's inflation, companies are starting to thrive now. They're looking to expand, so they're looking to expand efficiently in this kind of fickle environment. Inflation's going to affect everyone's bottom lines, so I think companies are playing chicken with the workers. They're holding out for better candidates who want a lower salary. Remember, as time goes by, your desperation goes up. This is desperation. This is you that's unemployed. Desperation of unemployed person over the months. As you start to drain your savings and you start to run out of money and not have a job and your savings is going down, and your bills are past due, you get to a point where you become desperate for anything. And then you go work at Walmart just to have a paycheck. I think we're still in the phase where workers are like, you know what, I can get that salary if I just hold out a little longer. But I think as time goes by, it's going to be the workers that start taking less of a salary, which means inflation is going to hit people even harder. If companies are expanding, what I think they need to do is I think they need to pay people the extended salary, but all that does is make inflation go up still. And so in this environment, I think it's just going to be like a slow bleed out. Like they're going to wait. And I think we're just going to be cyclic and noisy for a while as the world figures itself out. High inflation just makes things weird. Like you have problems that jump from place to place. They jump here, then they repair slowly. They jump here and repair slowly. And sectors have smaller bubbles that form and pop, and the problems here get fixed. And there's a problem here, food and energy. Oh, now it's housing. Oh, now it's materials. And you just get like this weird kind of lag effect as everything's tied together. But once like a boom happens somewhere else, then it kind of fades out and then it trickles to somewhere else. And things just kind of dance around each other in an inflationary environment. It's not like a real clear data set where everyone's experiencing the same problems. We know food and energy is a big part of that right now. So I'm saying this is what I think Powell's going to talk about, the same shit. Wait for inflation to come down. We're still years away from our 2% target. We might commit to rate cuts by 2024. And the reason for that is just to not put the scare on Wall Street. They don't want people to get laid off again in droves. The economic data is improving. They know that improving commerce over time will bring inflation down. The market will stabilize. You'll have enough unemployed people that they won't lower salaries, that they'll suffer for a little bit, making less money. They'll buy less things, which companies need to become more efficient to make their products cheaper. And then all of a sudden you get inflation coming down. Slow down the economy a little bit, but I think Powell doesn't want to scare the stock market and create layoffs again. So again, same old narrative, nothing changed, nothing different. Is monthly res for the monthly? It's monthly options of the next monthly OPEX, Robert. So what monthly resilience is looking at on the S&P is it's comparing the S&P's current value to the stocks in the S&P and what they're doing with their monthly hedge pressure. See right now, monthly resilience is starting to die, which I don't like. That's not the good sign for the trade I'm in. I'm still hanging on for it. But let's go ahead and look at monthly hedge pressure break to the downside, right? Let's go monthly hedge break down. Let's sort by distance. And we'll see that we have like NVIDIA today, right? NVIDIA is right on the surface, challenging monthly hedge. As a matter of fact, that's the reason we probably just got a move so drastic in the S&P. That is a big thing right here. NVIDIA, losing the market cap on NVIDIA. So what that means is that you're looking at the integrity of all the 500 companies and what they're doing at monthly hedge. As NVIDIA is losing, you're going to likely see some, you see how it's very sensitive to just that one big market cap stock right on the edge. So this is kind of like that thing where, now this updates every 2 seconds. This might not have catching that, but NVIDIA is like dancing right here. So the same thing that we're looking at the flux from here to the box with half gap resilience. The monthly resilience is it's similar, but it's slightly different. It's just looking at the flux through here. We don't look at like sensitivity and a redistribution zone. We just look at a range around monthly hedge pressure. So like right here, a heavy market cap, high market cap stock like NVIDIA is going to make this very sensitive. And so that's why I look for monthly hedge break to the downside. And then I look for heavy hitting stocks that are breaking to the downside. High volume, just to see what's going on. NVIDIA is on that list. Netflix is on that list. See what it's doing right here? It's not good. I don't like my trade now. This is bad. Okay. Got 45 minutes till Pal speaks. I don't know if I wanted Netflix on there, Nvidia. It's gonna try for the same thing happened yesterday. The float failure, and the market just traded down. Not usual market today. Do I want to hang on to that? I don't like it. I should probably start lessening my load on this. Momentum's starting to pick up. Just what an interesting, like, this is defying everything I'd expect. So this yesterday plus today are both very weird days. I think it's just the balancing act going into the monthly. I'd hate to see the market collapse going to the monthly expiration. That just does not seem fun for like a greater bull market. But that does lead to like Monday being surprisingly bullish. Okay, this is the last part of this here. And monthly hedge breaks are bad, so I should, by all my rules, be trimming or getting out of this. I committed to having a little bit more drawdown to maybe being part of this trade here still. I'm just not. Let's see. This looks good and strong for the go forward. QQQ is looking good. SPY is looking good. Bear trap, you guys think? I just know I feel better about this. I feel that this is next week. So to be clear, MHP is looking more, no, it's looking at this expiration, right? So MHP is the hedge fisher calculation using only monthly options of the next month. So this is looking at 1020. So what we do is we look at the next expiring month, because that's where the bulk of the risk is. We don't compile all the months together because we figured that the next month being just more actionable. All of the information together that's non-monthly would be the weekly hedge pressure. And then for monthly, we just look at the next month, like the one that's right in front of your face. Robert, if that answers your question. So this is compiled from all 1020 options and only 1020 options. And then as soon as 1020 happens, the very next day, on the 23rd on Monday, then we're using the November expiration. Did I draw DD bands for micros? No, they show up automatically. Livewire, that'd be strange that you don't have. Do you have liquidity map added? Make sure you have liquidity map added to your chart, by the way. Make sure your sockets are connected here. It's weird that it wouldn't draw. It draws all of them for me. Make sure you, when you click risk interval, do you have the information here? Do you have micro futures information here? What is it? Does it show the data there for you? How much your monthly map change after expiration? That would be their biggest change if there was a change, is either after expiration or after an event. Monthly map's biggest change that we've seen all year was after the Fitch downgrade. Monthly map shattered the bull market, shattered immediately. So after a major event, the very next morning, monthly maps shifted drastically. After monthly expiration is the biggest shift in money into new options. People roll into monthly options throughout the month, but that's where a lot of money expires and goes away. And so you'll see one of the biggest shifts in ownership typically that day as people are positioning for the next month who held till the end of the month. So usually the month is like an iron wall as you approach it like we are now. The visibility beyond that, while it is useful, I take it with a grain of salt, is that after Friday, this could shift. Does it shift drastically? Lately, we haven't seen it. We've had monthly maps for almost a year now on the chart where we can watch this very phenomenon. In theory, it should change drastically, but in practice, the type of market we're in, we have not seen it change drastically. In theory, you would expect a lot of rollover and a lot of changes and the market to just have more transparency. The very first Monday is your closest visibility for the next month. But we don't really see a lot of the greater change. We'll see that a lot of the back end stuff stays pretty much the same. So whatever like long-term options are here, we don't see that change a lot. What we have seen change is like the next couple of weeks in the month, and it hasn't been drastic despite us expecting it to be. So in theory, what that means is that, you know, people are hedging throughout the month, like I said, and there's not really as drastic of a change in practice around monthly expiration. People have pretty much already moved into their later risk early on, and that's why we haven't seen, after a year of watching this, we're not really seeing drastic changes like we thought we would. But that also could be a dynamic of this environment we're in. In a bear market, that could be a lot different. We would think that you would see your biggest shift there. If all days are equal without a catalyst, that should be your biggest shift. And what we have seen is that you might see the first couple of weeks move around a little bit, but we have not seen the entire market flip to bear structure one time. Now, granted, we're waiting for that to happen so we can observe and see that particular thing. Like if this is the end of the last bullish month and then the next month is when the market crash starts happening, I'm sure you would start to see evidence of that with a big shift. So if we shift into like bear market right after expiration, the monthly map should catch it the one time it happens, the rare time. So in practice, we haven't really been seeing the entire market structure change a lot. So, but the year we've had it has been a bull market. So when you think of it like that, bull markets tend to be more placid, less drastic, less change on a dime, and more resilient, less volatile. So the question is, in a volatile environment, Robert, great question. In a volatile environment where VIX was above 20, 25, you would expect the monthlies to be more drastic at the shift. So as we've proven by watching this, it's safe to say that because, monthly res is greater than zero now, perfect. It's safe to say that because we're in a non-volatile market, there's not a lot of surprise, which creates volatility. So monthly maps have been resilient month to month. They haven't really changed much after monthly OPEX, even though in theory they should. And maybe that's just a product of volatility. Long-winded answer. In low volatile environments, we're starting to observe that they don't really drastically change much unless there's a catalyst. The only drastic change was the Fitch slap downgrade that shattered that really solid bullish monthly map that we had. It was immediately the next morning, Robert. It was the craziest thing. Like, Fitch happened overnight. The next trading day, we had so it happened overnight, so those options didn't reflect it. One trading day went by, and then the very next trading day reflected it. So whatever Fitch day was, if it was a Wednesday, I think, or something, whatever day after market, it was 2 mornings after that. So Fitch was like immediately after a market close. Market reacted by selling. The next day's monthly map is still on the previous day's closing options, which is reported to Opera, which that event takes place before the Fitch slap. So that's frozen. The next day didn't catch it because people didn't have time to react to it. So the next day people reacted to it, and then they reported to Opera, and then the next morning we got the data. So if the event happens during the stock market, when it's open before the options market closes, the very next morning monthly maps will pick up that change, right? But if the event happens after hours, then you have a whole day of not seeing how that effect is, because people aren't able to liquidate their options once the Fitch downgrade happened. Monthly res back to being above zero, looking good. But it's a great question, right? So at minimum, if there's a catalyst midday, like FOMC shifts the market and tanks the market, the very next morning you will see that the monthly maps just shifted and reflecting that. Did we give a leg up on this? Absolutely. The minute monthly maps printed, I'm tweeting about it. Within, let me see my Twitter. Let me search for, let's see this. Let's see what I tweeted about it. Monthly map from let's see. So here, let me show you some of my previous tweets just so you can see this. So this is a solid monthly map, right? Robert, great question. You hear my kitty, Cheyenne? Oh yeah, he's on here again. So this is where the market was very strong and bullish. This was in June, and I said, breaking news, monthly map today changed from bull sentiment from late July to now October. It showed that we were bullish-ish until October. And so while we did rally until the end of August, around August, I also tweeted when it shattered. But this is kind of what a strong bullish monthly map looks like, how clean that is, right? Compared to what it is now, it's shattered a little bit. There's not a lot of cleanliness to that. Okay, let's find the next post I made about it. The monthly map showing a strong October 20 close. That was recently, right? We were talking about it coming back. This is bullish. This is bullish. Let's see if I wrote something about August the 3rd. Further analysis between credit rating change event and today's monthly map provided by Rocket Scooter. Like, you see how it shattered? So we were kind of on it. Let me see when the actual event happened. I may not have tweeted about it, though. So I see a choppy down week and maybe 2 and volatility collapse the next 2 weeks, showing the maps will be in business as usual. The bear writing is on the wall. There are some long-term problems with the market and economy, but traders, positions when they move. Right now, the overeager bears from a year ago are still slated to be punished for it through September, in my opinion. Okay, so that was at the beginning of August. So let's see what happened at the beginning of August. August the 2. So I made that tweet right here. So I was reporting on the monthly map shattering on August the 2nd, right? I changed my tone. Well, that was literally the day after. Okay. So I kind of was on top of it. I'm not going to lie. August the 3rd. So yeah, I was kind of on it. The bull positioning remains strong through September with little change. Okay. So at the beginning of August, the bull positioning remains rather strong with little change. And that was a great call because while it dipped, we literally closed through September with very little change. Not bad. Volatility, but little change. Not bad. A good call there. But we did start to see, I could have sworn maybe I just, the keyword I can search a little better, but if I go around that event, let's go to like, can I jump to this tweet? No. Volatility collapses, and we did call that as well. There's been no volatility in this market. Ashton was on top of that too, by the way. He's really smart at understanding volatility. So we did report on it. I think it's one of the tweets around then. I also said we've probably seen the high of the year, but my stance immediately changed, right? You saw me like weeks before that, just like the biggest bull on the planet. July. Monthly maps shows a bull market. In May, monthly map shows a bull market going through July, just bullish, 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 bullish. I mean, I was like screaming bull for the longest time. I should maybe do more keywords here. Here's another one in August. Oh, it's actually posting them out of order. Oh, okay. Let's just keep scrolling down then. The bull market's coming back for the quarter. That's in September. Okay. The bull market's coming back for the quarter. Not super bullish, but coming back for the quarter is for the quarter. So that is still on the fence. So back when I did this at the end of August, I had the ability to say bull market's coming back for the quarter and a little bit of dip, but I still think we're closing out higher in for the quarter. I still believe that, by the way. But you can just see that like monthly maps got shattered and I'm no longer like very, very, very bullish like I was before. May said, everybody's like Chicken Little, sky is falling, and it's like, no, we're still rallying, we're still rallying through October. And then I think the Fitch downgrade was a so I made another post after Fitch. Like, see how Fitch just, here's for you, Robert. Do you see that? So this was, I'm tweeting on August the 3rd. And I think that the Fitch event was what, like, so it was the evening of August the 1st. So August the 2nd was the first trading day, and August the 3rd was when we got the update, like I told you earlier when you asked. So after market, that happened. We had a full trading day, then that happened. August 3rd is immediately the first day. You see how quick that is? How quick that beautiful bull, oops. How this beautiful bullishness shattered the next day. It looked like that. And that, isn't that cool, Robert? It catches it like that. It's very awesome, yeah. It immediately was like, this is a problem. Oh, my trade's doing all right. How am I doing? A little bit better. You see how it just like vaporized literally overnight. So these are all from August. So I did follow it. So just so you know, I am on top of it. I forgot that I did stay a little bit on top of it. I did. I remember I was also traveling at the time. Yeah, I was traveling. But I did chime in a lot to help you guys out. July 28th. May, so this is all before that. September. That's probably the end of that. Ooh, here we go. There's that half gap trade. See, this is the trade I wanted to get. I'm looking all right here for now. But yeah, it just immediately vaporized. So it's that good, right? It's that responsive. You just need a full trading day to kind of like, how's resilience? Oh, resilience is positive. Well, I'm going to hang on to that. God, I got lucky here. All right, let's figure it out. Please stay positive. Now, you know, in all honesty, one should trim. My confidence is lower. So let's trim. Take a little bit of profit and got some market thrown at me. Let's take a little risk off. Still very confident though. Jay Powell's going to save us. So you took your profits part? Yeah. I'm gonna be a little more aggressive on this one. I feel like the greater bull market's gonna win today. I do. As you see, the monthly maps now are starting to. And so, Robert, you know how to read this one, right? The different, like how to analyze this. You're looking at the bottom of the bull zone, so like where these bottoms of the dark grays are. And as they're going lower, that is strengthening bullishness as longs entering the picture. As at this current price, you have deeper options in the money over time, which means more forced hand longing to delta, right? So deeper bull zone is bulls accumulating over time. A top of the bear zone, which is the light gray, is as you go over time, puts get further and further out of the money. It's less short hedging and more short covering. If puts are expiring and there's not any in the vicinity, then shorts are not going to be in their position beyond there to hedge against them. So you've got a twofold rally on a short squeeze and long accumulation. So it's looking great. Now monthly hedge pressure is looking solid as fuck. I'm not gonna lie. Why don't I just go in? I don't care. I like it. I like the growth here. I think good. No, I'm just playing 3 micros, but I think we'll get there. I think if Powell's talking, I think we'll get there. Now the R&R is really good on my trade now. I get a second chance to decide if I want to bail on this or not. If we break monthly hedge pressure again and this starts to challenge again, I'm done. But this got really good. NVIDIA saved itself. You know, we looked pretty all right there. Livewire, it showed it from our MMQ. Yeah, it shows DD now MES. What did you do differently, by the way? You clicked hide and then unhid it showing up? Like you clicked hide and unhide, like you had to refresh the indicator to get to show up? Oh, interesting. Can you message your experience to Slacks? Because he's logging like all these little hot fixes so that we can just say, hey, by the way, here's a little trick I noticed. This helps this one thing. Because then we'll code around it to solve whatever the issue is, but yeah. Just hide and unhide and refresh. So removing the indicator and adding it back is basically what triggers the drawing. Yeah, okay. QQQs look the same going forward till the end of the year. Doesn't seem that bullish November, December. Right, and so the sensitivity this far out, being so far away, you know, you could think about it like this. It's so far away that while I do believe it is, right, you have kind of like, it's a little more bearish towards the end of the year, a little more bullish. There's a little bit of a discrepancy here going into the end of the year. This is a little muddy and hard to read. So what I'm going to do with this is I'm just going to say, this is hard to read. Let's wait till we get closer and see what it tells me. Look, choppy, bull bear, bull bear, bull bear. What? That's weird. And then the end of the year, it's a lot of bear zones. And a lot of this effect could be, like this is our first year having this, could be having to do with like end of the year expiration, right? There are people that, this is probably why it gets really put heavy in the last weeks of the year. As all the longs just load up on puts, they can hold through the year for tax reasons, probably. Oh, Andrew is here. Slacks is here. Okay. So this right here, I wouldn't put a lot of stock into. As we've discussed this before with the team, this could just be end of year mechanic and not really sentiment, right? End of the year hedging. People that are long the stock market all year probably maybe have monthly puts just so they can hang on all year, right? So correct. These maps seem to be less calls, but the thing is that it's not really, don't think less or more. Think of the distribution. The important part of a liquidity map is where the bulls and bears have a line in the sand. That's it. This could be billions of dollars worth of options. Just because there's more, it doesn't mean stronger. Stronger is by comparison. You want to compare the strength of the bulls versus the strength of the bears. So while, yes, a deeper bull wall would mean there's more options there, like there aren't enough options here to trigger the algorithm to say bull zone. That's one thing. But in reality, what you care about is where that line in the sand is drawn. There are enough bulls right here to counter all of those bears. So in reality, magnitude in theory, should mean that there are more probabilities for upside move. Like if these pockets, like we don't have a study that does this, but in theory, if these walls actually look like this and were really nice and strong, it would be, in theory, a stronger bull market. But does it move faster? That's the hard part to say. But what we have noticed is that the interface between bull and bear is all that matters in deciding bull or bear market. So just zooming into right here, it doesn't matter that this goes all the way down there and there's nothing up here. This is strong bull. The strong bull and strong short squeeze. So the idea comes down to the algorithm is comparing bull and bear side, not just like what it's trying to do is split where the bulls and bears are relative to what the risk is at that level. So this could be 5 options and this could be 10 options. This could be 50,000 options and 100,000 options. A light week, it doesn't matter. Where's the seesaw tilt one way or the other? Pal speaking soon, okay. Hey, look, I turned my trade into a win. Let's go. But in reality, this is actionably as strong as this. This just means there's more people wanting to buy at higher prices. But there's still the same amount of people that are willing to buy at lower prices. That's really what you care about as a trader. So Ashton is digging into theories of like, what does the length of the bar tell you? Well, in my opinion, could we get something out of that? Maybe. But the thing about it is, if you think about how options work, there could be some, like, the question is, can that possibly move faster than this? Or does that move faster than this? Does the fact that this is just really light right on the edge, or like really heavy right on the edge and light above it, make it stronger or weaker than this? And the original theories between Ash and I was the answer is no. Because options up here are so far out of the money that they don't even really matter. 480 SPY calls, nobody's going to be buying SPY to play with that option. The further out of the money you go, the less probability that they're actionable. So the further close to the money that you go is where the action really is, based on options, right? The length of the bar doesn't represent anything, Robert. That's what I've been saying for the last 10 minutes. The length of the bar means absolutely nothing in this particular theory. What matters is, what does it look like where you are right now? The nearest the money is the most amount of hedging that you see. These puts at 390 and 380, nobody, the deltas are so small, nobody's shorting the, like for day-to-day moves. Any of these puts, nobody's having any action on them, right? I'm actually green for the day. How about that? Does this make sense, Robert? Just the interface is all that kind of matters. And that the reason because is that like a Delta 50 option is going to have the highest gamma, so the highest change in order flow. Let me pick a different color besides gray. So like right at the money, you're going to have the highest change in order flow for all the options in the vicinity. All these options out here, even though they're there, they could be part of complex options trades. Nobody that sold these options is out there buying the stock. They're still out of the money. Yeah. So the question is, Ashton is exploring, can we derive any information from the idea that there's out of the money calls and puts? Can there be, there might not be any direct hedging action, but can we structure our trades in that environment? Could we expect that beyond a certain place, is there still bullishness? Should we sell options beyond a certain threshold? Like, we're exploring, like, what does this information tell you? Like, what behaviorally is different here than here when there's nothing to go off of, or there's not enough options to trigger? So in practice, this is what it means. It means here people are actually holding, right? There's not going to be a lot of expiring options relative to the entire landscape that are going to force people into long trades. So this is this is like people that are holding. This is people that could buy. If they're both sloping down like they are, but this is like little thin bars, then what that means is the bulls are holding, and the theory is that there's bulls that could buy or shorts to cover. If price goes up, it can cause maybe a faster chain reaction. But they both mean the same thing, is that if the price goes down, the supports are still the same and solid. Great question, though. These represent strike prices. So these are drawing risk zones at each strike. I like that my trade is winning. I can't complain about that. It could be shorts against calls. You probably could be right. So in practice, the idea is that what we teach you guys is that on the cheat sheet is really all that we have a solid theory that's practice that you can use in practice all the time. Let me open your cheat sheet really quick. So all that we teach right now on monthly maps that is tried and true. So these are the things that we know so far that are actionable. Is that if you are trading in bull zone, then you're in a bull zone over time. It's a bull market. Bulls are buying dips, and that's all we're telling you. So if we're like, price here is in a bear zone today, bears are shorting highs, which we're seeing. As 2 or 3 days go by, we're trading in a bull zone, so bulls are willing to buy dips. It doesn't have anything to do with out of the money so far. The next thing is the bottom of the bull is sloping lower. You have more calls in the money at a certain price, which means bulls are going to be longing more as the weeks go by because you have more calls in the money expiring that week. And as theta hedging takes place, which is adjustment to delta hedging due to theta expiring options, you're going to force people into trades closer to expiration. So this is this expiring day, the 19th. This is the 23rd. This is the 24th. These are options just for that day, and we daisy chain them together. So if you think about like right now, the bull zone sloping down, it just means that there are more forced hand longs than forced hand shorts. This bear side sloping down means that the bears are there's more forced hand short covering than there are shorts entering. So more forced hand longs, less forced hand selling, more forced hand short covering, less forced hand shorting. Shouldn't I be greedy today? Take some profit. So in theory, correct, and it's 100%. Now you nailed it, right? That's exactly how you read. In theory, you have to preempt it with this: if price stays the same today, and price moves to that day, it's more bullish and less bearish this day. And if price stays the same tomorrow, it's the same bullish and bearishness next day. And then this day, it looks like the Monday after monthly expiration is kind of unclear what's going on. But then the following week, if price stays the same, it's bullish here, and then it's neither bullish nor bearish, and then it's deeply bullish here. If price stays the same, over time, the bull market becomes stronger. That's how you read it. You nailed it. So what you're reading is that over time, the market's getting stronger and weaker. And over time, the short side is just getting weaker as well. The bull side is getting a little stronger. So when you zoom out, what the monthly map is supposed to do, I don't like to treat it like actionability, like it's noisy when you look at it day to day like this, expiration mechanics and things like that. But over time, there's a clear trend on both sides. So one would say, through November, we're likely going up for November, rather than crashing out. Because we're not really, if price stays the same, we're not in a bear zone anywhere. It's not bearish at all. It's either bullish or bull supports down here. So it's certainly not bearish. So I have that mentality to say, okay, well, things are looking great there. What does volatility look like over the long haul? And we can do the same thing with volatility. If price stays the same, volatility is bullish-ish this week and then not bullish the next week and not bullish the next week. So volatility is also mild. If it stays at 17, it doesn't become very scary. So you don't really have volatility. We're not trading in a volatile bull market when it's going to explode and trade higher. Volatility is going to go up. So volatility is relatively benign and stable through October as well, November. And as you say, Robert, you nailed it 100%. I'm glad that you understand how options work. You nailed it, bud. Right. As price changes, then the monthly map is more likely to change more as the dynamic of the environment has shifted. So if price and options are tied together, if we had a drastic sell-off today, then the options would reflect it tomorrow. So you're right. They go back and forth. So price moves up or down, the monthly maps will shift nearer the money. The shifting would take place very rapidly as people's real sentiment, comes out. So you nailed it, 100%. So you will go in, and that's why I read the monthly map every single morning, as a monthly map responds to changes in the market. Changes in the market can be pressured by the monthly map. So the monthly map shows where induced selling and buying will happen as options come to expiration. People are forced into trades. That's what it's telling you. It's not the human side of the market. It's the insurance side of the market. So as the market moves on human stuff, human buying, human selling, whatever, then there will be new options, and options changes the landscape. The monthly map will reflect it the next day. So as the market changes, people buy new insurance. The very next day, the insurance is acting upon the market by forcing some buying and selling, and people are buying new insurance. And so it's like a cat and mouse back and forth kind of thing. So every morning you read the monthly map and you know what kind of the near-term state is, all things being equal. And you always say it, all things being equal. If price stays the same or all things being equal and there's no catalyst, then market seems to be on a trajectory to be more bullish over time, all things being equal. And that's where you start. You always say that. There's no guarantee. You get it, Robert? And trade stock market's random. There's zero guarantee. You can't predict what it's doing. All things being equal, if price kind of stays the same on the S&P, what's the patience of the traders in it? Well, the patience is showing that shorts are more willing to cover than bulls are willing to liquidate. And that's exactly what it tells me. So that's where you kind of go with that as finally as a combo. It's a great question. I'm glad you brought that up. Let me remove and add liquidity map back. Maybe that will remove and add liquidity map back. Okay. Okay. So all things being equal, if the market was just going to sit here still and do nothing, and the bulls are staring at each other and the bears are staring at each other, who's going to flee first? Who's got less patience in this market? That's really the strength here. All things being equal, if you were just to stare at a chart as a bear, one might have confirmation bias and say, aha, the market's going to sell off because it just looks like it's trending down. But if you look at monthly map, it says, well, by the natural structure of how things are positioned now, all things being equal, it looks like if we just held flat over time, it's probably going to start curving up more than it's going to start curving down. And that's how you think about it. According to the read, that's what you're reading. And again, there's no guarantee. It's just what the structure is now. And the structure can change, as you say, as price changes or sentiment changes, or new events, catalysts come out. So that's it. Who is more likely to win, all things being equal, as of today? The bulls are more likely to win this, or the bears are more likely to lose. Pairing it with the monthly map on UVXY, there is no pending volatility build over the next month. Nobody is scared of the market. So less volatile, more liquid. Liquid markets don't crash. Stronger bull, weaker bear. One could build the case that all things being equal, we're likely to close higher rather than lower. And then, of course, I come every day and look at my day-to-day stuff. Is DD still bullish? Check. Is S&P still above monthly hedge pressure? Today, check. We survived it. We wake up Monday with a whole new monthly hedge pressure. Another thing to take note of is monthly hedge pressure comes closer to price as you go to MOPEX. So when we have a new, like we're in a bull market, if price stays the same, monthly hedge pressure and price come really close to each other towards the end of the day, in the month. And now the new month, if we stay the same and it's still bull market, on Monday, you'll see monthly hedge pressure drop below, really far away again, and you got another bullish month to go with it. So on Monday, if we're opening above monthly hedge pressure with bull structure again, with bullish liquidity map, bullish GD, then that gives you a lot of strength starting Monday to really see out this market, and that it's more likely to go higher rather than lower on multiple mechanics. Heading out part later, bud. Does UVXY hitting half gap while SPY hitting half gap have any relevance for your trade? I don't see. That's a question that we've been asked a lot. Redistribution zone on VIX, we don't use that for anything. And it does pivot, as you see. We just don't have a way to gauge or tie break those pivots into one direction or the other. VIX can bounce off of bull zone bottoms and hedge pressures all the time, and we have rules for that. But VIX in the redistribution zone, we don't have any rules for that. Because this is one instrument. It's not an index. The strength and resilience is because S&P is an index. It's tracking a bunch of stocks. So we're saying, like, what are the stocks doing in these zones? And is the S&P doing something different than the sum of the things it's tracking? Okay. But UVXY is an instrument that tracks one thing. It's one thing. It's not like an aggregate, so it doesn't have that ability to create like a resilience or something for it. So now the question to answer what you said was, does UVXY hitting half gap have any relevance for your trade? It has no meaning in our rule set right now. It's half gap, open and close are always pivots anyways, but we don't have a method to tie break the pivot. Like the probability it's going to bounce or not bounce, we don't have any gauge of that. Maybe we can figure something out one day, but currently we don't. So we kind of ignore it. The rules at the UVXY are if you hit bull zone hedging or hedge pressure hedging, we know it's going to go up. But what do we know about half gap and open and close? Do we have any gauge if it hits here? What can we use to let us know it's going to bounce? It's hard to say. Volatility is very, very, very hard to predict. Good question. Solomon, you were in deep drawdown today, but you held to the MHP positive now, go to close before Powell. You guys are so smart. That's it. That was good luck for us. The greater bull market saved us. I feel great. I like it. I'm probably gonna get out of here because I gotta go to the airport and pick somebody up after their month-long trip to Asia. So I'm gonna get out of here in a little bit. Oh, no Zoom call today, everybody. Sorry about that. Because I'm gonna be very busy all afternoon. I'm gonna post the ones from yesterday and this week though. This market, right? Fucking A. Is Powell talking yet? Oh, Powell's now talking. Oh, it's moving before Powell even opens his mouth? Let's read. He can't be saying stuff already. The policy setting committee is proceeding carefully. All right. There we go. There's the monthly hedge tap. Let's review. We got resilience. Goodness gracious, pal. Why you do this? Why are you doing this, daddy? Will I cover this by 2 p.m. or might let it go past? I'm just going to hold until I hit my targets. Res is positive. We're going to fill the gap to the upside. Let's go. Come on. Don't be crazy today. Policy stance is restrictive. I did want to dive in at hedge pressure. I should have touched it. More evidence of above trend growth that the labor market is no longer easing. That's what I said. Could require more monetary policy tightening. QT. Threats of QT. Let's rally on that bad news, baby. Let's go. Talking about QT. There'll be minimal tightening in the pipeline. Well, of course, that's what we said. Remember my thesis from today, ladies and gentlemen? All right, I'm getting a good little catalyst here. You know, fuck it. Let's just take the $500 and call it a day. I'm out. Whatever. It's another winning day. I forgot how long the streak has been. It's been a while since taking a loss. All right, a couple weeks. Whatever. Okay. So I probably should hold it there, but you know what? Powell's throwing me a bone. I just don't want to deal. I'm going to call it a day. I got to go run to the airport. Okay. Very quick. Very quick. As we talked about this, JOLTS going up. Continuing jobless claims going up. There's problems in labor market. First thing Papa Bear says is that more evidence of above trend growth that the labor market is no longer easing, and it's not. Continuing jobless claims going up. JOLTS are going up. It's not. There's a disconnect in the labor market. Who proposed that before he talked? See, I told you we're going to predict what Powell's going to say, and we predicted the first thing he said. This is why you're here learning from me. This is what he's looking for. Recent data shows ongoing progress towards inflation and employment goals. Okay, they're getting there. CPI's ticking up, is still not the best. I'd be closing in hedge pressure right now if I was still in this trade. And that was my target, but hey, it moved too quick. I hate catalysts. Fucking hate them. Market's moving a risk interval, everybody. This is a risk interval move. This is the exit point of the day on the dip. This is one RI move on S&P. Now we're entering catalyst territory above here. Be very careful. This is one RI, one risk interval. Let all your friends in chat know. It's about 30 something, 31 points in the bottom. Fuck yeah, boys. Let's go. Boys and girls, you made a trade. Throw some rocks in the chat. You long, you short, you do anything. I trust Papa Bear Pal in the greater bull market. We're not going to sell off an expiration. Monthly maps for the win. Fuck the noise. That was easy. Easy peasy. Okay. Boys, let's go. Hedge pressure tap, one RI catalyst. That's it. Perfect. Okay, so that's it. There's your one RI. Hold on. So this is the one risk interval move. That's the cat area. So that's it. People close. Look at this. Closing a hedge pressure. You smart kitty cats out there. Okay. All right. So let's read Powell's saying more Powell stuff. So in tightening financial conditions with higher bond yields can have implication of policy. We remain attentive. Well, higher bond yields make bonds more attractive for the Federal Reserve. That's how they make their money. But more evidence of a but quantitative tightening would be they're not going to let them roll off. They're not going to hold on to them or buy any new ones. More evidence of above trend growth that the labor market is no longer easing could warrant further monetary policy tightening. That's it. There may still be meaningful tightening in the pipeline. They're not going to go into a stance of QE at any point in time. There's also a testament to the resilience of the market. Powell would be easing if things are getting bad. If things are good, they're going to keep tightening, which is fine. Low summer inflation readings very favorable. September data is somewhat less encouraging. Well, he's basically saying the CPI is ticking up. We understand that. U.S. interest rates futures up after Fed's Powell speech as traders make bets on no more rate hikes. Correct. I don't think I said anything about rate hikes here, but rate hikes are noise at this point. And I'm going to teach you one more thing that I've been teaching for you a while. Rate hikes are going to be noise. 100%. The market is not going to change direction on rate hikes right now. Quantitative tightening is the real catalyst. The bond market is the real catalyst. Why are yields going up? Because the Fed is no longer buying treasury bonds. Quantitative tightening is one of the major reasons why bond prices are collapsing. Well, premiums are collapsing in bonds and yields are going up. The Fed prints money by buying treasury bonds. They're the ones that buy this stuff. So your goal is to start trying to plan Fed's tightening and easing policy more than rate hikes. Rate hike is garbage noise. It's not going to change direction of the market. I predicted the rate hike almost every single month and for months in advance. We predicted they're going to taper to zero. Right now, we predicted that we'd have one at max rate hike between September and the end of the year, and that by the beginning of 2024, we'll probably be flat to cutting into summer. And that's any smart economist out there is seeing the same thing. Rate hikes is not. See, the news is just dumb. That's not what people are not betting on no more rate hikes. The news people don't know what they're saying. That is so priced in, nobody's making bets on that. People are making bets on the greater policy of things. So, return to your inflation likely may require a period of below trend growth. Some further softening of labor market conditions. Opening remarks delayed by climate protesters. Oh, really? That's something to note of. Anyway, close at hedge pressure. God, you guys, do y'all like Rocket Scooter or what? Do you like our tools? I'm telling you guys, we're killing it. Fed swaps from odds additional interest rate increase. One max. That's it. They're going to keep raising interest rates over the next 2 or 3 years. This whole we're going to cut rates in 2024 is not the greater purpose. In 1982 to 1984, I wrote a thesis where the Fed did the same thing, cut rates for a year or two. Stock market came down for a year or two, and then they rose rates significantly after that. We're doing the same thing. Here's 2023. I'm calling it 2023. 2024, going to get a couple surprise rate cuts. And then 2025 to 2027, get ready for rate hikes to up to 10% reserve rate, 12% reserve rate. It's going there. It is going there. But guess what? Don't think bear market. Because the 84 rally, the 1984 rally in the stock market rallied even with rate hikes. And you remember from 1984 how long we rallied for? Let's see how many of you, without looking at a chart, take a guess. How long did we rally for in 1984 once the rally kicked off? Mind you, in a very, 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 very aggressive rate hiking environment. I'll give you a hint. Internet. Because the rally lasted for 15 years until the dot-com crash. So don't think rate hikes are scary for the market. They're conditional to what you're dealing with. They are going to nuke inflation. They're not going to just spat at it with a fly swatter. They will nuke inflation, I promise. They will. There's no way around it. They need to slap the market, but they need to make sure the market's strong enough to handle it. Powell is a chairperson that studies past chair people. He always talks about, other people that did this. He literally studies past changes that have made effect. I know I can read between the lines. He's staring at the same environment. The inflationary environment of the early 80s. This is exactly where we were. And that created one of the strongest Reagan-era bull markets. Was one of the strongest bull markets that we saw in our lifetime. I think he's trying to do the same thing. He's not going to try to be aggressive out the door because they want QT, because they know the bond problems are coming. They don't want to hold on. They don't want to be propping the market up here. They want the market stabilized for a little bit. And they need to bring inflation down. They will nuke it. They won't just trickle it with a quarter of a point. Imagine in 2 years, they'll be coming out with a point to a point and a half to 2 points per meeting. Just get there. It's going to be 50 basis points on average point a meeting. It will have to get there if inflation doesn't come down. But they're not going to be aggressive now because they can't throw the stock market into shambles by scaring people too hard. Because that gets more people fired. He's not going to do that until the labor market, whatever he was talking about, starts getting better. The labor market is still kind of at odds right now. They're not going to be aggressive on their rate hikes policy. This is exactly how you read the Fed. They can't scare the stock market to cause mass unemployment because then the market crashes. And high unemployment with inflation is called stagflation. And the only recovery from stagflation, from a crash from up here, is quantitative easing. The Fed will have to come in and rescue us, and they don't want to do that. They want to tighten. So if they crash the stock market, we're going to force them to bail us out again. And they're ready to get out right now. So Powell is driving the ship very carefully. Their narrative is saying, the median vote for policy is saying lower rates for the next 2 or 3 years. That's what they're forecasting. But I bet you when 2 or 3 years comes up, inflation's not going to be solving itself as quickly. And the Fed will nuke the market with high interest rate changes, but the bull market will not care. Will be strong enough, the economy will be growing, and people will rally on economic data more so than they'll care about the Fed. Fed rate hike might drop the market for a day or two, and then it's back to rallying. I wish I was alive in the 80s to trade it. It was the most fun, probably, bull market to ever trade. It just market went up and up and up and up and up. So we'll see. If we open a catalyst, will disqualify that. You nailed it, because right back here, it's a catalyst. So when you're irrational on a catalyst, 1RI, none of the rules apply. So the rule of bull market, bear market, bear market means non-irrational market. No triggers. So any of the irrational signals trigger, that rule is to be taken with a grain of salt. Powell was escorted out of the room as protesters interrupt the Economic Club of New York speech. What? Climate change protesters. Oh, that's funny. Not funny. Climate change. Yeah, I mean, we should. I care about the environment. But still, it's funny. How being escorted out of the room because a bunch of picketing hippies. I'm a hippie, I'm not gonna lie. So anytime you move more than one risk interval on an event, Robert, none of our rules, we set out, we can't use our rules. We don't use liquidity maps, don't use hedge pressure, we don't use anything. The integrity goes away when markets are moving on an event. All structure, though, throw all your indicators out. None of them are going to work. Don't use anything, not just our tools. Throw out your RSIs and your Elliott waves, your harmonics, all that stuff. Just throw it out. Nothing won't be good. Somebody said, stupid question, but can I explain how I trade your minis? I'm buying shares on your positions every day. I'm trading futures, Randolph. So I'm just day trading futures. I'm actually buying micro futures. So I'm just buying and selling futures. Have you ever traded futures before? It'd be similar to buying and selling a stock. You just buy a contract, sell a contract. So I'm not buying shares. I'm buying contracts, if that makes any sense. Okay, cool. So that's what I figured. So your question is, what are futures, right? So like a share of a stock is a share of the company. A futures contract, think of it as like a share of an amount of some commodity. An example, easy example I understand would be oil. I can buy like shares of ExxonMobil. I own a portion of ExxonMobil's company, right? The shares are a portion of the company, and the shares go up in value. CL would be oil itself. If I want to buy one contract of oil, it equals 1,000 barrels of oil. So in commodities or futures, it equals an amount of a commodity. So somebody that's buying and selling one contract of oil, you're really trading 1,000 barrels of oil at a time. Now, in retail traders like us, I don't really actually have the ability to own that oil. Our brokers don't let us actually hold that contract to expiration. But if you hold that contract to expiration, you're required to deliver the oil. It's a contract to deliver oil. When traders, we just trade the value change of the contract. Just like an option would deliver shares of stock. Like if you're trading, in this case, ExxonMobil options, calls. If those calls go in the money, somebody owes you 100 shares if you want them, right? So calls exercise at the end of their lifespan into retrieving shares of a company. So options, right? Options allow you the ability. An option is a contract that you can enforce to have someone deliver shares. Futures are a contract that you can enforce to have someone deliver you the oil. Now, one thing is that in the equities world, you have puts and calls. They will force you to take the shares if you're exercised on. You'll be forced into that trade. But in retail futures trading, the exchanges do not allow you to actually accept delivery of the physical commodity. If you're trading through a futures broker, the brokers will always close your position out before they expire. You'll never be in that situation where you're contractually required to give wheelbarrows full of gold or truckfuls of wheat to somebody. So a futures contract, an options contract goes up in value when the underlying stock goes up in value. The options contract will change relative to the Greeks. The Greeks are the calculations that really reveal the valuation of the option. Futures go up in value based on supply and demand of that contract. It's very simple. Just like options, I mean, stocks go up and down based on the supply and demand of the stock. So as oil prices go up, the value of that contract goes up. If I have a contract to deliver 1,000 barrels of oil, and oil prices are going up, which means the price that oil is delivered at. It's not to do with the market price. The market price we're trading is not the price oil is delivered at. Oil and other commodities exist physically in the world. if I had a boat full of oil, a tanker, and somebody called me from the shore and says, hey, I need to buy some oil right now. Can I get 100,000 barrels for me? Yeah, sure, I got it. They're not going to look at Thinkorswim and say, well, what's the price of oil? They're going to ask me, how much are you selling it me for? And it's a negotiation between me and him. We set the market, me and the person buying it from me. It's called the spot market. So I'll say, I'll give it to you for 65 a barrel. He goes, I want 64. I go 63 and a half. So whatever. And then we say, okay, that's the price. And that's the price of oil. And that transaction's recorded in a place called Platts. And people are watching the spot transactions. Oh, crap. People are paying more and more for oil prices. Shit. Okay, so then the futures market responds by pricing higher in the value of futures. The contract becomes more valuable. So that mechanic is what makes oil prices, contracts go up and down, directly proportional to the actual price of the commodity itself. So you're just buying like a share of stock. You buy it. If the commodity goes up in value, the contract goes up a certain amount of value. And it's a fixed value. You get a certain amount of, just like a stock. If a stock goes up a penny, you gain a penny per share. If oil contract goes up a 10 cents, you gain like $10 per 10 cents. It's a fixed, I mean, it's not one for one, but it's a fixed amount. The S&P, if the S&P goes up, S&P ES future contract goes up 1 point, the value of my contract goes up $50 per point. So $12.50 per quarter. And so since it ticks in sizes of a quarter, every quarter it goes up, my contract goes up $12.50. So really think of it like a stock that goes up a fixed amount. And that's really it. All the complexity of what values it and all that, you'll never have to know as a futures trader. You just trade that, it goes up in value when the underlying goes up. Now the S&P is a little different to understand because while oil contract delivers barrels of oil against commodity and gold delivers 20 ounces of gold, S&P doesn't deliver an S&P. There's no such thing. S&P futures don't deliver anything to you. They're the one, and like futures, like equity and treasury products. I don't think treasuries deliver anything to you as well. Like they basically just settle out in cash. Like they're just pure gambling instruments. They don't really deliver anything to you. So if I am an S&P contract that expires, I would just be required to pay the loser, or pay the winner, or get paid by the loser if I'm winning against them. So it's a cash flow swap in a way. That's basically it. With no premium, or no cash, like a cash flow swap with no collateral. Essentially, it's a cash flow between two traders. And the reason they exist is because they allow, well, for the futures industry, I think they wanted to get into the index game. But in the commodities world, it gives you options really to acquire your commodity. There's pros and cons. If I want to call somebody, I need oil. Well, ideally, if you have a business, right, you're a bakery, you're going to need flour every week, a certain amount, and you plan for that. You don't want to just be calling somebody every week and grabbing market price. You want to lock in a contract for a long period of time between you and a seller. And the contract is stability for your business. Contracts are good. That you have the ability to guarantee that you get delivery because your business needs it every day regardless of price fluctuations. So the futures market allows the fluctuations of supply and demand to be passed onto traders who are betting against each other, speculating, rather than having every time a drought happens, the price of cereal goes up 4 times and prices fluctuate wildly. The futures market in general acts as a gigantic buffering to consumer experience of the prices and the downside. Like everyone that's delivering these commodities to each other are locked into a price. They take the hit, or we take the hit in the market. They don't take the hit. They're locked in with each other at a fixed price. So it allows fluctuations in the commodities world pricing without completely annihilating the whole logistical chain. Mad cow disease makes your hamburger at McDonald's cost $40 because cows are dying. Doesn't happen. The changes become smaller as the risk is like buffered through traders. The loss of that is felt by a trader in the futures market, not by a farmer. That's really the way to think about it. So like when you're just trading the futures contract itself is exactly like stock. There's a little bit of nuances to it, but it's just like a stock. It goes up, you make money. It goes down, you lose money if you're long. And there's no Greeks like options. This is a lot simpler to trade than options for sure because there's no Greeks. Catalyst still active in the S&P, by the way. And I do got to go in a second. Excuse me. That was gross. If QQ has a yellow, would that disqualify SPY from bear? No. So yellows don't disqualify. Reds are the disqualification. Yellows are just caution. Yellow usually means it broke and then came back. So the rule is done because of the catalyst rule. Catalyst is active. Catalyst active. Watch the Discord. I'll just let you know it is. Catalyst rule active. When I move on ES, throw out all rules. So the minute you break one risk interval, throw out all rules. No rules. No rules. All things turn off. Great explanation for futures. Can you do a similar one for options? Gamma and delta. Okay, so options are a whole different ball game. Options are a contract similar to futures. You buy a contract from somebody. So one contract, you're a trader. And then we'll say a dealer. A dealer sells one contract. And let's say that you bought a contract that's a call, which means you're telling this dealer, I want to accept delivery of 100 shares of this stock. You're just telling him right out the door, I'm going to take 100 shares of that stock if my call goes in the money. If my call's in the money, I want the stock. That's how they perceive it. In reality, it's if it goes in the money, I might want the stock. The I might want the stock instead of I will take the stock. The difference between futures is that if I have the oil contract at expiration to buy, I am forced to buy that oil. If you sold an oil contract and you hold it till expiration, you owe someone 1,000 barrels. That is a contract. They can sue you if you don't deliver. You must deliver and you will lose that suit. So contracts are enforceable. You can't sell a contract for a commodity you don't own. So if you pump out 20,000 barrels of oil a day, you're not going to be out there, selling 30,000 barrels a day to your purchaser. You can't supply that. They will sue you for not coughing it up. So it's enforceable in futures. You must deliver. Options are called the options because you have the option to take it or not. It's a maybe, and the maybe gave birth to the Greeks. What's the probability? This guy, the dealer, what's the probability that he's going to take these shares from me? And how exposed do I want to be? That's constantly the pain of the option seller. And what the Greeks do is that options have a value that changes. So let's say this evaluation, value of options changes when the value of the underlying changes, okay? And so they are independent markets, let's start over, but they listen to each other. So the probability that his calls go in the money because the value of the underlying is going up means the contract is also more valuable to a degree. How much more valuable is based on the independent market of options itself, the supply and demand of those options versus all other kinds of things. The time it takes, how much time you have left, all of these things factor into this person's question of maybe he's going to take the shares from me. Well, if there's a lot of time left, then maybe he'll change his mind if price goes down. If there's a little bit of time left and it's really high above and way in the money, then the seller's like, oh, he's probably going to take the shares. I'm fucked. So because options are a maybe, Greeks were invented, or Black-Scholes and other models were invented to price in all the, well, maybe this, maybe that. Oh, well, time is in effect. Risk-free rate is in effect. Being at the money is in effect. Being out of the money is in effect. What's the probability that he's going to want the shares or not. And that probability goes up, the value of the option is going to go up. And of course, the option being its independent market, the option is going to go up differently according to the willingness of people to supply those options, the bid and ask. If the ask is thicker, then the option has less resilience to price and more resilience to price. So what quotes the bid and ask is market makers pricing the option. So Black-Scholes was invented as a model for them to take all of those maybes and throw probabilities into the valuation of options so they can accurately quote prices on them based on the probability that that option strikes in the money at expiration and that trader is going to want the shares. So because there's all kind of maybes to that, you need a very sophisticated pricing model because it's not as direct. There's no spot market that says, well, this guy was selling oil to this guy for $50 a barrel, so we can kind of peg futures contract to roughly $50 a barrel. I mean, that's kind of where we're going to trade to. If that's what everybody else is trading out there, the contract's going to drift towards the spot price. But you don't have that like pegging action in options because they're independent markets. The options have their own supply and demand, and so the underlying. Now, while the options they're trying to peg themselves to a value, the option itself doesn't have the same value. The futures contract has a value, $50 of oil for $50 of oil. This is the spot in the contract. But the option, just because the stock is $100, the option's not $100. So the option value is set as a probability that the contract is valuable because of the probability of going in the money expiration. So you think of all the things that go into it. Well, the further away, the less probable this happens, the closer it is. Not okay, so time is a factor. So you find out all these different factors. So the price of the underlying factor. Sure, if the price of the underlying goes up, then the probability of that person wanting those shares, because calls probably go in the money, goes up. Okay, so price of the underlying is a factor. And they find all these factors that allow people to figure out how they value these options. They take all those factors and they create a model like Black-Scholes. And Black-Scholes is a very large differential equation. If you have many different pieces of a differential equation, you can create partial differential equations to weigh out two things to each other, and then the Greeks are invented. So the Greeks are like plucking out different parts of differential equation. Theta is, okay, let's look at how time changes price relative to how far in or out of the money you are. Delta is how much the underlying price changes, how much value will the option change, the velocity of that. The first derivative of that's the acceleration. And so they basically just used a giant differential equation that's just trying to calculate value of pricing an option for market makers. And then the Greeks are chopping that up into smaller pieces. That's the easiest way to describe it. It's a more complex answer, but it's basically what it is. So Black-Scholes is like the master equation that sets the price of an option. Right. I'm trying to explain it in like an easy to understand way. And they found out a lot of things affect the price, volatility being one of them. That's actually a kind of a weak version of it. Maybe Wikipedia has some better models. Black-Scholes equation is a parabolic partial differential equation, which describes the price of the option over time. And these are all the things. So the Greeks are chopping up that equation into smaller pieces to peg a couple variables against each other. And here they are, the options Greeks. They measure the sensitivity of a value of a derivative product, blah, 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 or changes the parameter values while holding the other parameters fixed. That's typically what you do if you ever took a Diffie class in school. You have a large equation. If you take like, if you have, let's do a transform version, like x plus y plus z, and x and y and z are all relatable parts of differential equation. If I wanted like the change in x, or like del x over del y by fixing z, like you have three variables that are all tied together, right? They're all equations that rely on each other. They're recursive. If you hold one constant, you peg one against the other. That's what a partial is. And so that's what you're doing. You take you take the sensitivity of some value, like time, for instance, or velocity of price, acceleration of price, etc. Changes in volatility, acceleration of volatility, velocity of volatility. All those parts are different differential equations. Partial differentials are the major equation by holding other parameters fixed. So in reality, you're pegging like, what does volatility have to do with price? What does change in the underlying price have to do with the price? What does time to expiration have to do with the price? While holding everything else constant. Anything that doesn't have a 2 is just a direct linear relationship. Delta is velocity. Velocity is a first order like this. Anything with a del squared is acceleration. So like gamma is the acceleration of price change. Delta is the velocity of price change. And so these are the equations of that. But essentially, they're all pieces of the bigger equation so that people can more fine-tune, have a little bit more granularity to understanding the direct effects of one step change. If volatility is going up, how should I price the option? Well, a differential equation is very impossible to solve with that complexity. So instead, they created a Greek so that you can solve that one particular piece. If volatility goes up, how should I price the option? Oh, the underlying price just went up 3%. What should I price the option? Oh, let's use delta and gamma to adjust the price of what we quoted at. And that's what Greeks are. Like I said, options are very complex. Very complex. All kind of math goes in. This is delicious math. Papa Bear loves it. And I think they might tell you what all these D's and S's and stuff mean. Price of the option, price of a call, price of a put, time expiration, time until maturity, strike price. What does D stand for? But yeah, that's basically it. You see how that's a very complex question? The black model, what is D? Long story short, it's a bunch of calculus. You don't want to deal with it. D is the discount factor. Okay. So, yeah, there you go. So an example is like, V is the price of the option. Is a function of the underlying asset S at time T. Okay. So the price of the option as a function of the underlying price. So it's the option versus the stock, VST. You come down here and it's like delta is the change in the price of the option against the change of the price of the stock, which is what delta is. How much the option price changes versus a change in the underlying. Gamma is the second derivative of that. Vega is the change in price of the option versus the change in price of small sigma, which is the standard deviation of the stock's returns. The square root of the quadratic value of stock's log price is measure of its volatility. So each one of these things are things that options sellers determined give them more accuracy in pricing option based on the probability they expire in the money and the person wants the shares. So they come up with tons of catalysts. Don't trade with the fucking catalyst. I tell you that all the time. Look at what the market did. All right, I'm out of here. I love you guys. Anyways, options are very complex. Great question though, right? It's harder to make good analogies for options, but essentially it's just a way to price them if you're a seller of them. Kind of need some math to do it. A lot of complexity there. The Greeks are just chopping a big equation to small equations. Pin two variables against each other when there's a pool of dozens and countless variables that could be there. So they invent more Greeks to figure out relationships just to have more accurate pricing. Makes options very complicated to trade, does it? Makes futures a little bit easier. You don't have Greeks and futures, so check out that drop. Hey, catalyst, baby. We don't deal, right? That was a great. Oh man, hedge pressure out. That's what we say. Throw your rules out the door. I love when I shout at everyone in Discord, throw your rules out the door and bye-bye rules. You see that? Market just selling off. 40 points a drop in 20 minutes. I'm on the sidelines with my $500 in profit. Love you guys. We'll see y'all later. No Zoom call today. I'm sorry I got to run, but we'll do something.